Hello, and welcome to the February 10th, 2026 meeting of the Governmental Accounting Standards Board. Great to see everybody for our virtual board meeting. We have a good number of things to get to, and we want to get into it. But first, we wanted to introduce a few new members of our GASB team. We'll start with a new project manager who joined us about a month ago-ish or so, Jessica Blaha. We're very excited to have Jessica join the team. Jessica, if you want to introduce yourself briefly to the group, love to have you do that.
Yes, so hello everyone. Yeah, as Joel said, my name is Jessica Blaha. So I recently joined the technical staff, and I greatly look forward to supporting the board's work, drawing on my public sector auditing background. So thank you so much for the warm welcome. I'm glad to be here.
Welcome, Jessica. Very excited to have you on the team. We also have two new postgraduate technical assistants, or PTAs, joining us just out of their college programs. We're excited to have them and look forward to working with them. I will go with Claire's name is first alphabetically a first name. So Claire Devink, you'll want to say hello?
Yeah, good morning, everyone. My name is Claire Devink, and I'm coming from the University of Wisconsin-Madison. I'm grateful to be here, and I'm looking forward to working with you all this year.
Excellent. Welcome, Claire. Great to have you. And Marissa Turner.
Yeah, hello. Good morning, everyone. My name is Marissa Turner, and I'm from The Ohio State University. And I'm very grateful for this opportunity, and I'm looking forward to the year ahead.
Welcome, Marissa. Very excited to have you both. Look forward to working with you and seeing you around the office. You've been with us for about a month now, too. So awesome, and welcome to the team. All right, with that, before we get to our first topic, we do have minutes to approve. Minutes from our last board meeting, which was December 9th and 10th of 2025. And I guess we need to approve the Taxonomy Consultative Group, or the board meeting we had with the Taxonomy Consultative Group, for which we prepared separate minutes from our meeting with them on December 9th, 2025. If there are no comments on either of those minutes, do I have a motion to approve both sets?
So moved.
Second. Diane. Second. Thanks, Robert. All in favor, say aye.
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 Any opposed? Hearing none, both sets of minutes are approved. And with that, we can move to our first technical topic, which is the implementation guide update. And we have a ballot draft of an exposure draft of an update to the implementation guide. Lisa Herker, I will turn it to you.
Excellent. Thank you very much, Joel, and good morning, everybody. It's nice to see you. And I know I speak for the whole team when I say how excited we are to kick off the February board meeting here with a ballot draft, a ballot of an exposure draft of a proposed implementation guide that's really focusing on the financial reporting model improvements, specifically the subsidies part of those provisions in Statement 103. So like we normally do, we will bypass the front matter to get started. We'll start with the actual meat, if you will, of the implementation guide, and then we'll come back to the front matter after. So with that, I'll open up any board feedback on the introduction or the applicability of the implementation guide, which are paragraphs 1, 2, and 3 in the ballot draft.
Thanks, Lisa. Any board comments on 1, 2, or 3? Don't see any comments there, Lisa.
Okay, thank you, Joel. We have gone through this quite a few times. So now I'll open up paragraph 4 and the question and answer 4.1.
Any board comments on 4.1? 4. Nothing there.
Okay. I'll open up 4.2, and before I do, just one slight editorial suggestion that I want to bring up, and it's on line 8, where we added, as a result of the donation we're going to add an S onto the end of donation to make it consistent with the rest of that question and that answer. Any additional thoughts on 4.2?
Excellent. Thanks, Lisa. Any comments on 4.2? Looks good.
All right, how about 4.3, the question and the answer?
Anything from anybody on 4.3? No feedback.
Okay, so we'll move on to 4.4, the question and the answer. And one thing I'll note here, and I should have said right up front, where I'm going off of the marked version, not the clean version. So attachment A, line 33, the sentence there that begins with therefore, instead of the research grant, we would make it those research grants.
Any comments for the team on 4.4? No comments, Lisa.
Okay, how about 4.5, the question and the answer?
Any board feedback for 4.5? No comments there either.
Okay, how about 4.6?
Any board feedback on 4.6? Nothing there either.
All right, how about 4.7?
Any board feedback for 4.7? I see none.
Okay, and then last in this section, 4.8.
Any comments on the last new Q&A added? No comments, it looks like, from us on 4.8.
Okay, and then how about paragraph 5 and question 5 and answer 5.1?
Any board feedback on the amended question and answer? No board feedback there either, Lisa. We've been through this a couple of times,
We
so
have.
we're
All right,
looking
so
good.
how about the effective date and transition paragraphs, paragraph 6 and paragraph 7?
Any board comments, 6 and 7? Nope. No feedback, no comments.
Okay, how about appendix A, the background, paragraphs A1 and A2?
Board comments on appendix A? Don't see any.
All right, how about appendix B, the amendment as marked for changes?
Any board comments on appendix B? No comments there either, Lisa.
All right, and then appendix C, which are the codification instructions.
Any feedback on the COD instructions? No board comments.
All right, so let's move to the front matter. How about page I, which are the written comments and other information sections?
Any board comments on page I? No board feedback there, Lisa.
And then how about the table of contents? Page II.
Last but not least, table of contents. All good. Looks good to us.
Excellent. Then Alan, I think we just need a vote.
Yep, you do. Sorry about that. I had to unmute for a minute, sorry, because I was muted, so sorry about that. But we do. We need to vote. Ask the board if they do not object to us actually publishing this as an exposure draft for the implementation guide. So start with
Please
Jeff.
proceed.
Jeff,
I do not object.
Chris,
I do not object.
Carolyn,
I do not object.
Diane,
I do not object.
Jackie,
I do not object.
Robert,
I do not object.
Mr. Chair,
I do not object.
that's awesome. We will get this thing published.
Only
So
thing, the only thing I
everybody,
need to mention, send those if you don't mind
Yes.
emailing your signed ballot to Reagan. And I believe you all have her email address. If for some reason you don't, just let me know and I will forward that to you. But we're hoping to get those signed ballots. And then the last thing I'll just do is welcome Marissa to our team here on the implementation guide.
very good. Thank you, Lisa.
Thank you, everybody.
And team, appreciate all the work. Look forward to this getting out and to the feedback from stakeholders as to if they have any comments on the proposal, and then getting ultimately the implementation guide out to help people with their 103 implementations. So appreciate all the work. With that, give us a second or two, maybe a few seconds to transition teams. Our next topic is infrastructure assets, looking at another draft pre-ballot of an exposure draft in this case. So give us a minute. All right, Scott, are you ready? Team ready?
Sure.
Excellent. All right. Well, Scott, if you'll kind of start us off and walk us through what we have here for infrastructure assets, that would be awesome.
Okay, great. Well, we have before you a pre-ballot draft, and just like the project before, we'll start with the meat of the document and come back to the beginning sections. So we'll start on page 1 with the proposed standard section. Standard section, I'll probably go paragraph by paragraph, and when we get to the basis, I might lump some paragraphs depending on how the discussion goes. So, with that brief intro, page 1, standard section, paragraph 1. Any comments?
And Scott, as a pre-ballot draft, we have some editorial comments maybe from the board members. You want us to maybe focus on the more other things, but you've got the editorials, and we'll see another version at some point. Is that correct?
Yes, we have the editorial comments, and we will make them, or I will attempt to reach out to you and discuss. If we don't agree with it when we go to the next round of the ballot.
Excellent. All right. Very good. All right. Any comments on? You just said paragraph 1, right?
Yeah.
Okay. Any comments on paragraph 1 from the board? No comments on that one, Scott.
Paragraph 2.
Anything from anybody on paragraph 2? Nothing there.
Paragraph 3.
Any board comments on paragraph 3? Jackie?
So I know we decided we were going to take networks out behind drainage, water, sewer, and things like that. But now that we've done that, those words by themselves look kind of weird without something behind them. An infrastructure asset called drainage or water, they're kind of words in and of themselves without giving any. I mean, water is water, right? It's not necessarily a system. Drainage is drainage. It's not necessarily a system. So I was wondering, do we need a word in there, or do we not need a word in there? I know we didn't want networks, but I didn't know whether systems would work or not.
Jackie, I see your point. I think there's another, I don't want to say opposite point, but another related point that I kind of noted that to me answers your question, but also could create other questions. So maybe the solution is somewhere, but it's because that is preceded by these being examples of
Right.
networks of infrastructure assets. then the words are kind of okay, but also are all of those things networks of assets? And that's where it might get a little, and do we want networks there, or are these supposed to be examples of infrastructure assets, in which case your point is valid? Diane.
Well, I had the comment that I would remove the networks of, because I don't think they're all examples of networks. And I would also add a heading just before paragraph 3 of definition, because this is a really important section. And I think having a heading that draws the attention to that is important.
Thanks, Diane. Jeff.
I agree with Diane. I had us taking out networks of. So this was just going to be infrastructure assets. And then we talk about networks in paragraph 4. I talked a little bit to Scott. And Scott, you sort of thought about maybe instead of water and sewer, you would put something like pipes or something like that to sort of indicate water infrastructure assets. And maybe we could do drainage systems or something like that to make that an asset. But I definitely agree with Diane's comment.
Jeff. Scott, do you have any? Well, let's get Robert. Robert raised his hand. Go ahead, Robert.
I don't have a big problem with it the way it is, but if the rest of the board is more comfortable with getting rid of networks of, I can live with that. But I think I get Jackie's point, because water and sewer by itself just seems kind of out there. But then are we going to then say lighting systems, drainage systems? I think we've in our previous conversations on this topic, systems has been eliminated, and I didn't do a word search from the document. So I think we might be safe in that regard, but water and sewer is everything from treatment plants to pipes to everything. So we get real granular if we started just saying pipes, but systems in my mind conveys the entire utility, so to speak.
Thanks, Robert. Carolyn.
I read this paragraph a couple of times too, and I ended up being okay with the direction that staff was going. I mean, if we do make changes, I would be concerned with trying to get too granular if we start to tack on systems or something other to the networks that we're talking about. So I would be open to that, but I came away with, what the staff has presented is clear to me, and I was fine with that.
Thanks, Carolyn. Alan.
Not to dissuade from the should we take networks out or not, but I'd be careful putting the word system back in, because system denotes something bigger and larger than a network of assets. System is all the people and processes and everything that goes along with it. So a system is above a network. So my belief is we took system out because we weren't trying to talk about the bigger thing. So I wouldn't bring system back in. That's the one word I wouldn't use. Doesn't mean we can't take network of out. And actually, if you took of network out of the preamble, you could say water and sewer networks and probably solve the problem that way.
Chris.
Yeah, I agree with Alan. I remember some extensive conversations around system and the reason why we intentionally did not want it included. So I don't think we should go that route. In reading through, I guess I get Jackie's point. I also, I think it flows. The only thing that bothers me is really drainage, because water, sewer, dams, lighting, all of those things really, to me, fit in an effort. Infrastructure assets, and I don't think we need a clarifying word like networks or systems or something like that to bring it together. I think drainage kind of doesn't fit in because maybe some assume it under water and sewers, but all said, the other piece to Diane's point about, I guess it's line 18, part of a network, I do agree with that. And um, I think we can clean that piece up. But just to clarify though, the last sentence, buildings that are, that have a primary purpose, we are leaving network of in that piece because that's a completely different thought. So we're not talking about removing it from both, just the one up at the top of the paragraph, correct? Okay. So all that's to say, I'm fine with the removal network of. I'm okay with the language as is. Maybe deleting drainage because I don't know that it really adds any value there. I think we give enough examples. And then I think personally that with that, there's no other clarifier or additional language that's needed, but I'm open to whatever else somebody else might want.
Got a lot of ideas, I think it seems like. I don't, Scott, if you had something you thought worked better.
I mean, if we added stuff, as I said, I'd probably add pipes and pump buildings or something like that to water and sewer. And drainage would be a little more difficult. You'd probably say something like pipes, trenches. Or if you'd have the, what they call the basins or whatever that is. But
Okay, so Jackie.
So I like the idea of putting a subheader in there with definitions because Diane's correct. This is really important that they focus on this. I'm okay with getting rid of network of infrastructure assets, and maybe we just drop drainage. I think if these are just examples. Roads, bridges, tunnels, water and sewer, dams, lighting, maybe that would work without any additional words on it. And if we just drop drainage.
Jackie, would you keep networks of in, or you said take
I
it
would
out?
take network. I'm fine with taking it out.
Okay. And so you're okay with water and sewer, just
Yeah, I
that's
think
an
if we leave
example of
water and
infrastructure
sewer together
assets.
like that, they'll kind of get what we're talking about. I think
Okay.
that by taking networks out, there may be some interesting ideas of what those infrastructure asset thingies are. We'll get a lot of variety, I think, but I'm fine with that, I think.
Okay. I'm gonna come back to try to get that one sentence fixed first, then come back to Diane's idea for the header. I was kind of like Carolyn, I'm kind of okay with it as it is. I kind of think all these things are networks, and then that helps drainage be okay. It also doesn't really bother me. What Alan said about systems was that's why we took it out to begin with. At one point, I was kind of okay putting it back in because I think the thing that would worry me the most is to get too granular, like Robert kind of talked about, to put water and sewer pipes. And then, well, what about the treatment plants? What about all this stuff? And even drainage, as Scott pointed out, if you can put pipes, but there are trenches and basins, there's all these things. And so you start thinking about, well, they're really networks, right? It's not about system. It's about it's a network of things that go together to perform a particular service. And that's what we have in paragraph 4, where we describe networks. So maybe the easiest thing to do here is to have these not be examples of networks, but just be examples of assets. And I would hate to lose water and sewer. I would hate to make it any more specific. So I guess where I kind of end up is where Jackie did. They'll kind of sort of understand water and sewer. I'm okay if we take out drainage and then we take networks of out. Anybody thoughts on that or strong reactions one way or the other to that? Carolyn?
I would, I'm reading this over and over, and I think we should leave networks in because that's what we're trying to emphasize. And if there's something that is not an example of a network, I will be supportive of taking that out. But I would lean on the side of leaving networks. I don't have it in front of me because I'm going between screens, but I would be in. I would be more supportive of leaving the sentence very close to what we already have.
Thanks, Carolyn. Robert.
I just want to, Carolyn, when you say, so you would leave in networks of? Okay. I can go either way on this. I think, I don't think losing, the edits that were proposed to remove networks, I'm okay with that. We do define in 4 what a network is. So roads, bridges, tunnels, drainage, water and sewer, dams, lighting, and communication towers are infrastructure assets. So I'd be okay with eliminating the networks of, and then the edits as what the draft included.
Thanks, Robert. Chris.
Yeah, I'm where Jackie was. That was similar to what I was recommending as well. The removal of drainage and then also the networks of piece to remove that as well.
Thanks, Chris. Jeff.
I'm in that same place. I mean, as I think about it more, I find it a little odd to describe networks before we even told you what they are in paragraph 4.
Okay, thanks, Jeff. Diane.
I'm in the same place Jackie is, so I'm fine with the changes.
Okay, thanks, Diane. Carolyn, I'm probably, if I had to vote, would be in your camp and just leave it, but it seems like a majority of the board wants to take networks of out, take drainage out, and then everything else is as presented here. All right, that's what we'll do there. So now let's go back to Diane's, and I guess I'll look to Scott. Maybe is it okay to put a subheader or a header, whichever one, to say definition or something like that before paragraph 3? Like, is that we've done that before? It sounds familiar to me, but
Generally not in final documents, but if we do it in a standard, I would recommend moving it out of the scope section.
Yeah.
And having it next as the next section standalone.
As it be its own section.
It would go paragraph 2 to paragraph 5, and then 3 and 4 would go after 5.
Gotcha. Diane, you're okay with that? So 5 moves up behind 2, and then what are currently 3 and 4 come 4 and 5, and they have their own header for definition.
Yes, I am okay with that.
I personally kind of like that change. I think it's a good suggestion too. Other board members' thoughts on that? Jackie.
Yeah, I think that actually is a good idea, a good suggestion, because scope and applicability doesn't really get to what 3 and 4 actually are. So yeah, I think that's a really good suggestion, Scott.
Thanks, Jackie. Robert.
Agreed.
Thanks, Robert. Chris got a thumbs up. Carolyn, thumbs up. Jeff, thumbs up. Okay, let's do that then, Scott. All right, I think I covered everything anybody had on paragraph 3, but if I didn't circle back to something, let me know. Okay. All right, I think we're good with what was paragraph 3 with those edits, Scott.
Okay.
I don't think you called paragraph 4 yet, right? Correct.
Right. I did not.
Okay. Do that now. Paragraph 4.
Yeah. So paragraph 4, I do want to point out in the first, I'm sorry, I need to learn to count. The second sentence on line 26, we didn't add what was discussed last meeting about that the infrastructure assets may consist of. So the second sentence, starting on line 25, would read, a network of infrastructure assets may be only one infrastructure assets that may consist of many components.
That may consist of many components. Okay. Any comments on that, which I guess we discussed last time. So, but any comments on that or anything else on paragraph 4? I am not seeing any comments on that, Scott.
Paragraph 5.
Any board comments on paragraph 5?
Okay. And as I said, we'll move paragraph 5 up and it'll become the new 3, based on the board's previous decision.
Excellent.
We'll move on to paragraph 6.
Any comments on paragraph 6?
Paragraph
No board
7.
comments there. Sorry.
No, that's sorry. Paragraph 7.
Anything on 7? No comments there, Scott.
Okay. Paragraph 8.
Any board comments on paragraph 8? Don't see any.
Okay. Whoops, Jeff.
Yeah, Scott, I don't know if this is editorial or not, but in paragraph 8C, we say condition level established and disclosed. You'll note that's different than 8D, where we have established and presented as RSI. I think 8C should also be established and presented as RSI.
Staff would agree.
Thanks, Jeff. That's a good point. Any other comments on paragraph 8? All right.
Paragraph 9.
Any comments on paragraph 9? Don't see any, Scott.
Okay. Paragraph 10.
Jackie.
I think this changed from the last version we looked at, right? Because in that one, it said that the policy was supposed to be disclosed in the significant accounting policies, but this doesn't say that. So I was wondering, did we change our mind on where this would be disclosed?
Sorry, I meant to bring that up. In doing the codification instructions, this doesn't fall into an accounting policy. If you look at the other accounting items that are listed in the summary accounting policy. And so what staff has proposed is to still require it to be disclosed. We would propose to change, instead of saying should disclose, to more mimic what was done in statement 40 for investment risk policies that are required to be disclosed, to have it say should briefly describe that policy. I know a couple board members had brought up that by not saying summary significant accounting policies, that potentially we lost that, fact that, the idea isn't for them to put their entire policy in the note. And so that's the wording that's used in statement 40 for investment policies. Investment risk policies is to briefly describe them.
Jackie.
Yeah, I think that's good because when we get to the basis for conclusion, we talk about briefly described there, I think, and I went back and looked at this and I'm going, but we don't say that here. So I wasn't clear on what we wanted them to do in 10 based on what we had listed. So that's helpful.
Thanks, Jackie. Chris?
I just want to make sure I'm tracking. So we're going to change this again to say briefly describe. Okay.
Rather than disclose on line 9.
So it would be governments with a policy for monitoring the maintenance and preservation of infrastructure assets should briefly describe that policy in the notes or something, briefly disclose a brief description of that policy, something like that. Other board member thoughts? Comments? Is okay? I'm probably not the best person to comment here because I didn't agree with this being a disclosure, but my concern for the disclosure was that it was either going to be boilerplate and not useful or way too detailed. And if I had to pick which of those I would be more worried about, I would hate for it to be way too detailed. So I kind of like this change, even though I think the result will be boilerplate and not very helpful disclosure, but it's better than the detail. So it seems like a good edit to me. And I think the idea was that it was always kind of a summary, and that's what the basis was getting at, and was a summary of significant accounting policy. So I understand why we changed it. But it did seem like it needs something else. So I appreciate the 40 reference and the brief description. So seems like any other comments from the board or good with that as Scott discussed that edit. All right. We're good then on paragraph 10.
Okay. We'll move on to paragraph 11. I will point out we left out one of the board's decisions last time to begin the paragraph with, in addition to other disclosures required by infrastructure assets, which the board had talked about to try to make it clear that this was not to be part of the current disclosure requirement where the government shows their beginning balances, additions, deletions, and ending balances of all the various types of major classes of capital assets.
Thanks, Scott. I appreciate that. Certainly was a concern of mine, and that they thought they had to break out their roll forward. Didn't want that. Any comments on paragraph 11? Robert?
Maybe it's just the way I read it and I just can't read this right, but it just isn't clear to me, and maybe the rest of you may disagree, that we want them to disclose both those that have exceeded their useful lives and those that have exceeded 80% in this disclosure. If you read through, I mean, if a reader goes to the basis and they go to Appendix C, they'd see that. But if they stop on just the standard, it's not clear to me. I don't have a good suggestion for how to say that without it becoming even more convoluted. But I don't know how to make it more explicit. So I don't know if others.
Robert,
they get it, and I just
should
don't.
Separate. Isn't it doing it enough for you?
Yeah.
So should separate the information.
Separate that have exceeded. I can live with the language as it is. I don't want to make this a huge long paragraph. And again, if you read the basis, you'd get it, but some people won't go there. So
Robert,
and the example in the appendix is very clear. So maybe those people who are, want to get to the end of the book will go to the example and they'll get it. So anyway.
Carolyn.
I think because, I've been in these discussions since the beginning, I might have been reading things that was not there. So I definitely see where it covers the 80%, but I think I do agree with Robert where if you're 100%, that could be missed. Or am I, when I read it back, the 80% is clear, is for me is very clear. It's the part that also, also if you're 100%, that could be missed. So that was just my take on rereading it and not reading into things that are not there.
Was Carolyn. Alan.
I hope nobody hates me for saying that, but if we were to switch it, I think what you have to do is you have to say, disclose everything that's exceeded their useful life in a table, and then disclose everything that's between 80 and 100% of its useful life in a table. I think to do it, you have to flip the order of what you're asking them to do. You first tell them to give everything that's exceeded its useful life, then everything that's between 80 and 100% of its useful life.
Chris.
Yeah, I am fine with the language as is, but I do agree that there's a priority or emphasis put on the 80%. And so it hides a little bit. The other piece, the separate is there, but it's kind of like an afterthought. So I get it. And so I think I agree with Alan that if we were to make a change, you'd have to flip it so that you'd understand the priority of both of them and that you're breaking it out. You kind of have to, turn the paragraph around. But again, I'm okay with it. I see it in here, but I agree that there's an emphasis towards the 80% because that's what we're leading with. And then there's that afterthought.
Thanks, Chris. Jackie.
Maybe it's as simple as just making it more apparent by putting something like exceeded 100% of their estimated useful lives from those that have exceeded 80% of their estimated useful lives. It just makes it more apparent.
Diane.
I was fine with the original wording, but I like the suggestion that Jackie just made. I think that makes it clearer.
Diane. So in Jackie's, it's right now, it's separate information for infrastructure assets that have exceeded 100% of their assets. So we would just add the words 100% in front of there.
Mm-hmm.
Robert, does that help? Carolyn?
I think that I think that helps without it getting overly wordy, which is where I tend to go.
Okay.
Joel, I do think that can work. I will say though that I've got Reagan in my head right now going, you just leave the word separate and you don't say separate from what. Does the word separate in that sentence make sense? I understand you're referring back to the prior sentence, but I could hear her actually asking us that later on down the pipe. And I think that's why those extra phrases, those extra words are there. You're saying you're separating it from what?
Okay. But Jackie's suggestion wouldn't change that then, though.
Correct. It's just adding two words. It's not taking anything out.
You're suggesting, Jackie, putting fully depreciated 100%?
100%.
Yeah, no, that's different. That's very different conversation.
Which highlights the separate, right? So it's even more clear that you're separating the 100 from the 80. Yeah.
And that was the point I was trying to make, Chris. I agree with you.
Okay. Jeff.
I was sort of where Diane is and Jackie about 100%. I would probably say you'd put 200%. You'd put one where people are talking about it, and then you'd put another one at the end of the sentence, but have not yet exceeded 100% of their estimated useful value.
It seems like a majority of the board would kind of rather do what Jackie has suggested, and that's helpful enough to provide the clarity. And I'd probably go with Jeff's too, because it just tracks through the same thing. As opposed to, as Alan kind of talked about originally, if you're really gonna change it, then you kind of really kind of reverse the order and change how we describe it. It seems like a majority of the board would rather do the simple add the 100% both places. I have an agreement on that, or anybody disagree with that? I'm seeing a lot of heads nodding affirmatively to agree with that. Okay, very good. So Scott, we'll add 100% in front of those two places.
Yeah, majority of the board agreed with that. I mean, I don't know if you want to talk about the adding an A and B, like Jeff said, with only you and him having commented on it. Adding that as well, the other board members.
Everybody good with adding it both places? That's what you're asking, Scott, right?
Yeah,
Okay.
yeah, in addition to adding what, the majority of the board said add 100% of their 100% of as wording in line 17, would you also want to add an A and a B between the, before the 100% and then B before the 80 to 100?
So you're talking about literally putting like an A to identify these are two things, an A and a B.
I think that's what you were suggesting, right, Jeff? I mean, I know you
No,
said
I was just, Scott, I was just suggesting that we put the 100% of also in line 18. Right, so we have it in line 17, and we have it in line 18. Whether there's an A or an a B in there,
okay,
right?
apologize.
That's for, I mean, maybe
Okay.
Reagan to determine.
Jackie.
I don't think we need an A and a B, but that's just my opinion. Based on what we've changed, I think it'll work okay.
Sounds good. No A and a B, but 100% in both places. And we'll see what Reagan says.
Sorry, I misunderstood, Jeff.
I think you took
All
care
right.
of it, Joel.
What's that, Alan?
I think you took care of Reagan's concern. I think y'all took care of it the way you
Okay.
did it.
Okay. All right. Anything else then on paragraph 11? Jeff.
Okay, I have a couple of things. First, in line 14, the term historical cost weighted average age of infrastructure assets. I will ask my fellow board members if you read that without the benefit of our discussions, would you know what we're talking about? Because when I read it, I had to go to the I see some faces nodding. I see you guys are fessing up. I had to go to the illustration to understand what the calculation was. And I'm concerned that the words don't do justice to the calculation in the illustration. And if that's the case, I think we should add a sentence along the lines of that calculation, A times B divided by the total of A, but put that in words so that a reader can understand what the historical cost weighted average age is, because I don't think many people or some people will understand what that term means. I'm interested what others think.
Jackie.
Okay, so I went back to my intermediate days in accounting, and I actually drew out what this was going to mean to me to calculate. And I came up with two different calculations for how this came out too, depending upon how I defined that. And I did that in Appendix A when I was working with the appendix and go, okay, I can get the same answer, Scott, if I do this, but if I interpret it this way, I get a different answer. So I was is it the total, the historical weighted average age of the individual components, or is it of the total asset that we're looking at, or the network of assets? So they could do that too, depending upon what they're looking at, trying to figure out the weighted historical cost weighted average of when they're doing the summing to come up with the total. So yeah, I came up with a lot of different answers when I was doing this.
Jackie, if I heard that correctly, it wasn't, it sounded like you started with, there were two different versions of the calculation, but it got to the versions were created by what your scope, what unit of account almost you included in it, not necessarily the method of the calculation.
Well, I had to think about the method of calculation too.
Okay.
I would say it wasn't intuitive to me. Like I said, I went back to intermediate and thought about, okay, how would I have explained this to my students? So it took me a while to figure out where I wanted to get. But then when I did, I was going, okay, I'm not sure exactly which unit of account I want. And I came up with two different calculations.
Okay, thank you. Chris?
Yeah, I'll just piggyback and agree that if we can have consistency here, I think that's important. That's one thing that I kind of got tripped up on, but it didn't happen until I got further into the example, and I'm looking at it and I'm trying to go back and recalculate it and figure out what did we mean here. Oh, I thought initially that we were just taking that line, that component piece, and then I realized we wanted the whole network. And so my point was that we just needed to be clear in the calculation of what we were trying to encompass. But the bigger point that I think the team is reaching, and I'm totally on board with, is that we need to prescribe if it's of the total or of the component here, and then just follow through with whatever the representative calculation is, and that'll make it more intuitive when you get to those examples in the back.
Thanks, Chris. Diane?
I agree. We need more description in this. I think that what Jeff said makes sense, that in reading this, it's not intuitive as far as what that means. I have some issues with the illustration because the label that we have on it is component, but I think some of the items that we list in that are not components, they're networks. So I think that there's some mixed messages going on between the example and then also just the needing more clarity with this part of it.
Jeff?
So I think Joel, I think we got to come to some sort of agreement. Maybe there's something got to be added, but I think some of the discussion is also bleeding into another comment I had about this paragraph, which is because we say they do it for infrastructure assets, and do you do it for a component? So if you have a component that's 80%, past 80% depreciation, but your asset is not, do you disclose the component? That's unclear to me in this paragraph 11. I think that maybe goes to that unit of account thing, maybe that you're talking about, Jackie. Like, I think we need to be clear, is a component disclosable here if the asset isn't disclosed, right? And I think that's what some folks are struggling with.
Okay. To me, there's two things going on. One is, do we need to describe the calculation itself better here? And then the second thing is this unit of account issue. Maybe we deal with the unit of account issue first, because I think it's a bigger, kind of more broad issue. When I read this and what I expected it, this could be, as I think Carolyn was talking about earlier, I know what I meant in this, or what I thought it was. I've been in all the discussions, so I know what at least I thought we were trying to achieve here. And to me, the words say that, but maybe it could be more clear. But what I thought we were trying to do is that the disclosure is by network, but the calculation would be done on each infrastructure asset you have. And we have, to me, intentionally been silent about the unit of account and what an infrastructure asset means to you, because our guidance up to now from 34 on has always kind of said, you can account for this in any way you want to, up to, at this point, up to network, right? Like you have to be able to disaggregate your disclosure at least by network. And so in essence, if you want to do a part of a road, the whole road, you know, all your arterial roads, whatever, however you want to, roads added in 2025, that could be a unit of account, right? We've not prescribed that. And I would kind of hate for us to indicate or change guidance that would say we're going away from that, because I think that would be a bigger change for governments. So we've, to me, intentionally kind of left this with whatever unit of account you use to determine what you think an asset is, that's how you apply this disclosure. And that's kind of the way the example worked it, right? And now what that does do, because we've added this idea of components and we're requiring different disclosure for components, is I think where we need to be more clear is once you take something, once you separate out a component from the rest of an infrastructure asset, does that component become an infrastructure asset, or is it still a component of an infrastructure asset? And because, to me, because we haven't prescribed a unit of account, I would almost, I think the quote unquote easiest thing to do, and none of this is going to be terribly easy, is to say once you break that component of the infrastructure asset item out, it becomes an infrastructure asset. That means we might need to clarify that somewhere, maybe not here, but somewhere in the text of the standard, if people agree with that. And maybe then that makes this easier. If a component becomes an infrastructure asset, then maybe these words tell you disclosed by network, but the calculation is on individual infrastructure assets, whatever that means to you. Thoughts from board members on that as a, I don't want to say solution, but as a possible solution that we still need to work on where the words might go. Diane.
Well, this is just a general comment, but I think the whole concept of the component has just made so much more, this has created so much more detail and confusion in all of this. It just makes sense just calling these assets infrastructure assets. So I just wanted to throw that in.
It's Diane. Jackie.
This is actually a fairly big deal, what we're talking about right now, and probably needs a little more thought than just doing it in the ballot draft here right now and coming up with the answer for it. Because obviously we thought we had the answer when it went to draft, and then when we started looking at pictures of it, we decided maybe we don't really have it. So I agree. I think, well, I've never been a fan of components from the first day, as we well know, but I think it is causing confusion where we break it down. At what point are we looking at? Do we disclose by components, by assets, by networks? We've got 3 terms here, and we're sticking them all in a paragraph here, and I'm not sure that it's clear from the reader's perspective what they're supposed to be doing. Are they supposed to be looking at components? Are they supposed to be looking at assets? Are they supposed to be looking at networks? And how does that disclosure work? So
But Jackie, what
as far as
Joel,
I'm concerned, if we could get rid of components, works for me all the way down the line.
but Jackie, to Joel's question, if you said once you componentize something, it is an asset, you've now eliminated component from the discussion. Because you've said components, once you componentize it, it is now an asset. And networks are accumulation of assets. So like that's
So then my question is, why do we have components? Because once we componentize something, it's an asset. So what are we accomplishing with components? And at what point do we draw the line
Parts of
between a component
assets
and an
have
asset?
substantially different useful lives from the rest of the asset. And when that happens, we want depreciation to more appropriately reflect that difference when it's big enough. I mean, that's
Basically what you're saying is we want you to subdivide your asset into small assets.
in certain circumstances, yes.
And think about this disclosure, Jackie, right? Your asset may not be at 80%, but your component is. And it's significant and it's a big part of that asset, right? So it does make a difference from that perspective as well, I think.
So yeah, I can kind of get that, but at the same time, I'm having a problem with when do they decide whether they've got a component or not? Because I know that's another discussion we haven't had yet. Do they decide they've got a component only going forward, or they decide they have a component going backward? So yeah, while I can agree with what we're talking about, I'm still stuck on the component piece and when component kicks in.
different conversation.
When you say when component kicks in, like transition guidance is what you're talking about. Which we will
Yes.
talk about that when we get to the transition guidance, I guess.
It's me, I think it's all related.
It can be related in a cost and I would just say cost, because ultimately 25 years from now or 30 years from now or whatever, once we've gotten through the transition guidance, then it's about, is that operational? Like, is it, do we understand what we want to do?
So I guess from my perspective now, what we're saying is if you put a new asset in place, a bridge, you got a bridge. We want you to separate that bridge into individual assets if there are parts of that bridge that are significantly different from others. So right away at the get-go on that, it's not a bridge. It's a bunch of different assets depending upon the value of the components to the total asset, right? So they've got several assets on that bridge right now, just not one bridge. So it's not an asset, it's several assets. That works. There's no component. However, if we're asking them now, if you're going and putting a street out here that I use all the time in my example, Fowler Avenue, we're replacing a piece of Fowler Avenue here. It's been there forever. It's going to be there forever. That thing's never going to get captured then by what we're talking on, because there's nothing new there. If we just go prospective, it's not going. So component doesn't even apply to that. It's just one asset. Right? And that's what we want. It'll never change.
I think that's a cost benefit decision the board is going to make or talk about when we get to the transition guidance, but potentially, yes, that's true.
So is the word component going away?
Guess Chris.
I mean, at a minimum, we need to figure out how we want to be consistent with even just the guidance that's back in paragraph 11, right? And the fact that we're not talking about components there, but in our display, we're talking about components. And, so I think we need consistency in what we're articulating there. So to Jackie's point, we probably need to reach a resolution on that and what we actually want that illustration to display.
See, Chris, I think what the illustration was showing is all those different lines are different infrastructure assets. So the overlay is a separate asset from the substructure. It wasn't, that's kind of what the discussion's about, right? Do you look at, in the illustration, you look at the surface, the overlay, and the substructure as a single asset, or as the illustration might predict, you look at those as two separate assets, and you have to do it, and you have to do 11 by asset. And so the surface is one asset and the substructure is one asset. And so those are two assets, not two pieces of one asset. That's kind of the unit account conversation we're having right now, is how do we want to think about that going forward?
So I guess my suggestion would be back in paragraph 7, when we talk about components, that maybe we add something that says, you know, once the component is broken out, the component becomes an infrastructure asset, and the remainder of that infrastructure asset is also an infrastructure asset. So we kind of defined that now we're not talking about components differently. They are their own individual infrastructure asset. And then when you read then paragraph 11 and we talk about infrastructure assets, it now is inclusive of a component is now an infrastructure asset. So paragraph 11 then doesn't need to mention components because we're not using that term anymore after you've kind of originally accounted for the transaction. That something like that is what I'm suggesting as at least a big part of the fix to helping paragraph 11. And actually the rest of the standard for that matter. Jeff.
I agree with your point, Joel, that we would have to go back to 7 and say that in order to make 11, in order to not have to change 11, right? And let 11 sit as infrastructure assets. And when you get to 11, you already know from 7 that if you componentize, that component becomes an asset. So I agree that would, I think that's the way it would work, and it should work, and I agree that solves that particular issue.
And in essence, it helps paragraph 6 too, right? Periodically reviewing, like, are we talking about components there? Or are we talking about infrastructure assets? Like, what's the periodic review of estimated useful lives? So it doesn't only help 11, it helps the rest of the standard a bit too. But thanks, Jeff. Robert.
So Jackie, does that get to what you were talking? I mean, I'm agreeing with Jackie. I mean, it's a separate asset. I mean, component, now it's just a separate asset, and maybe it's just as simple in the illustration where we had a header that said component, just said asset, just says, because I mean, those are just mathematical tables to show how you compute that. That's not obviously something that's going to be disclosed. The disclosure is shown on at the end of the illustration. That's what you would say. But I agree. I think we probably need to put something in 7 to clarify that, because if it's that distinct, it's just a different, it's another infrastructure asset, similar to what I think Alan was saying.
Thanks, Robert. Jackie.
Yes, I think that going back to 7 and saying that if you have a component that is significantly different, it now is an asset. It's not part of another asset, it's its own asset. And when I got to the illustration, my problem was I was looking at those as components, not as assets, because to me, they were part of the road, all part of the road. They weren't assets, they were the road underlay, the road bed, the road top, they're all part of the one asset, the road. So yeah, I think that helps with that part.
Thanks, Jackie. Yeah, I haven't really looked at the illustration, but we would follow through whatever we're doing here in 7 to make sure that the illustration mirrors that terminology wise. Carolyn.
I was just going to add, it's taken me a while to wrap my head around the component being its own asset. But as we're having this conversation and going back into, if we put that distinction in 7, I think it will clarify what we're trying to get at in 11. So I can see where we definitely need to introduce that in 7. Maybe 6, and then we won't have to. Then I don't think it'll be an issue in 11 if that's what we're trying to get at. So I agree with clarifying that if it's large enough, the component does become an asset versus still being a component of a larger road, or as using that example. So for me, that does make sense, and I would agree flushing this out more.
Thanks, Carolyn. Diane.
The clarification that you suggested, Joel, I think does help with that and helps clarify when you get to 11. I think in the example, yeah, we still need to work on that because I have a problem when you get to bridges being under a list that says components. So that's where it kind of threw me off, but we can get to that when we talk about the example.
Thanks, Diane. Chris.
I was right where Diane was. And for me, the example or the illustration it worked backwards, and that's what got me to this point. But I agree that 7, the change is necessary to make that connector very explicit. And then I just think we'll have to clean up in whatever way we decide in these examples, because I just think they add a level of confusion and you kind of second guess yourself on some stuff that you thought you knew beforehand. So if we just sync that up, we'll be good to go.
Thanks, Chris. So Scott, Alan.
Well, one last question before you finalize it. And maybe Scott, you might find this too. Just to deal with the other thing you said, Joel. Can 7 and 6 flip? And then 7 before 6, and 7 defines what it does the definition tweak you're talking about making. And then if 6 follows that, then you've already determined that what your infrastructure assets are. I don't think it hurts anything for those 2 to flip. It makes sense to why we put them in the order we put them in, but maybe it makes more sense based on this discussion to flip them.
That makes sense to me. But I'll kind of leave that up to you guys and the drafting. But I would personally like to define it, describe it, whatever we want to call that, in 7. What is 7? And then it just apply everywhere else in the standard. And so if it makes more sense for that to then come before 6, so that 6 doesn't have to change to have the same thing in it, and current 6 doesn't seem like the place to do that because we haven't talked about components yet, right? So I don't know. It doesn't seem harmful to me to flip them, if that's okay. But so Scott, does that sound okay to you? We're not giving you the words necessarily to do that, but that notion to add to kind of the end of 7, you're good with that as a direction? Okay. All right. Well, then sounds like a majority of the board's good with that. We'll do that. Now let's come back to 11. And we kind of talked and hopefully we've addressed the unit of account issue more or less. With the calculation issue now. So we've got this term, historical cost weighted average. And how do you calculate that? We've got an illustration that shows it, the calculation, and we'll talk about how it shows it when we get to it. But it shows it. Do we need a description of that calculation here? Or do people just go back to their intermediate accounting things or to the illustration and know how to calculate it, or does the standard itself need to describe it? I'm kind of sort of okay either way. It seems a little weird to describe it in the standard to me, but if other people feel strongly about it, that's fine. Jackie.
If I were to put it here, I would footnote it. I wouldn't put it in the standard because basically all we're doing is defining or describing what historical cost weighted average means. So I think that would be more appropriate for a footnote disclosure than to put in the standard. But I wouldn't have a problem doing that because I agree that maybe not everybody's going to go back and read the basis for conclusion.
I certainly, if we're going to do it, I like that idea better than putting a sentence in the standard. But Diane.
Well, you can always Google it too. But I like Jackie's suggestion. I think it does need a little bit more description, and not putting it actually in the standard makes sense.
Miss Diane, Robert.
I would agree with Diane and Jackie on this, and Jeff bringing it up in the first place that we need the definition, but footnoting it versus in the paragraph itself makes more sense to me.
Thanks, Robert. Carolyn.
And I'm fine with it just being back in the illustration, but if the majority of the board believes that it needs to be introduced earlier, then I can support it being in a footnote.
Thanks, Carolyn. Jeff.
Yeah, I think it should be somewhere in the standard. I don't think we should have readers rely on non-authoritative guidance to figure out what we mean. So, and I'm fine. I just think it needs to be somewhere. So I'm fine with the idea of a footnote if that gets it in there. I think that's a good solution.
Thanks, Jeff. Scott, are you good with adding some kind of description as a footnote? And I you know, my when we can use footnotes and not is not something I'm an expert in. So this
Okay.
seems like an appropriate use of a footnote to me, but
We can do
okay.
that.
Okay, very good. I'm good with that then. If we were going to put the sentence in the standard, I might have some reservations, but as a footnote, I'm good. Okay, sounds like we've got the board members all good with that. Is there anything else in Jeff?
I had one more thing on 11.
Okay, we've covered all the things that have been brought up to
We're
now.
sort of going,
Yeah.
going from larger to smaller here. So that's good, right? So this one I think is a little bit less daunting, but the way you read 11, right? I think the words on the page are telling the governments that if you have 100% depreciated asset, you got to tell me what the accumulated depreciation is. Now, we did not do that in the disclosure in the illustration. I know because it's not relevant, right? But read that paragraph, and governments are going to read that paragraph and say, the GASB's telling me I have to disclose what my accumulated depreciation is for my 100% depreciated asset. And I'm just wondering, I don't think we have to solve it here, but I'm just going to make a request. If we don't want that, we should attempt to write it so that 100% assets, you don't have to disclose accumulated depreciation.
Jeff, I understand what you're saying. And the illustration to me kind of does it, but it does it in a way accountants would kind of understand, because it kind of says they're fully depreciated, which means accumulated depreciation is the same as historical cost. And it almost seems like trying to negotiate that here in the words that are already kind of complicated to understand seems to add more complication than people figuring out in the illustration how to make that kind of known and it qualify. But so I would kind of rather just leave it. But if other board members are more with Jeff, then I do understand what you say. Jackie.
So going back to what we just said, that I agree with Jeff, we shouldn't rely on non-authoritative items for what should be in the standard. However, having said that, they're going to be the same thing. It's not, so what if they disclose both of them? It doesn't really make any difference, and it's not going to be a heavy lift for them to do it at that point in time. So I'm fine with leaving it the way it is, because I think this paragraph is getting convoluted enough the way it is. But I do understand Jeff's point, and I don't necessarily disagree with him. I just don't know that it's going to cause any additional angst to have it disclosed.
Thanks, Jackie. Chris.
Yeah, I actually thought it made sense to disclose, and that it's easy enough. It when you look at the disclosure, if you're talking about tables and everything, it's going to be consistent. So I actually I didn't think that it would be a problem as a preparer, and I thought that it would just be in a Excel spread in a spreadsheet. It's just the other column, and those columns are going to match, and that's the end of it. If I'm understanding Jeff's concern correctly.
Well, Chris, yeah, but remember, those columns are just background. The disclosure in the illustration is just the paragraph. And if you read the paragraph, it doesn't say what the disclosure is, the depreciation is for the 100% depreciated assets, right? So that disclosure illustration doesn't technically do what the standard says you ought to do. Because of all the reasons Joel is talking about, right? And that accountants will understand it, but
I might be missing it still because I just see it as when you accomplish like this illustration will be picked up and copied, and when you do that, you cover that disclosure requirement, right? And you take care of everything you need to take care of. So you have your narrative portion, whatever it is, but then you'll also have this table, and that'll disclose all the remaining information that you need to disclose. The fully depreciated amount will be right there, and they'll be done.
But Chris, I think to Jeff's point, the tables won't be in the disclosure. Like our example disclosure is only that one paragraph. And that paragraph says roads with historical cost and weighted average age, I'll leave the bridges about, were fully depreciated. So it gave the cost, it gave the age. It didn't technically say accumulated depreciation, but as accountants, we know because it said were fully depreciated, we know the accumulated depreciation equals that. And then when you go to the next sentence and it gets to the 80 to 100 ones, it said roads with cost, accumulated depreciation, it has the number and age. So technically Jeff's right. I'm just arguing accountants are going to know when it says fully depreciated, we know what the accumulated depreciation is, even though that word isn't on in the example.
But just help me out with this though, but they'd also be required to disclose weighted average. And when they do so, they do it in a table. So that same information that you just spoke about in a narrative, you'll be breaking it down.
But the table isn't part of the required disclosure, only the weighted average age of 32.2 years. Like just the result of the calculation is all that's required to be disclosed.
Okay.
Jackie.
So to get the paragraph 11 to align with the example, maybe we just say the cost and accumulated depreciation totaled blah, blah, blah for the fully depreciated. And I see Scott going, we just add those words.
Scott is nodding his head up and down. Yes, let's do that.
I've already
That's
done.
true.
I've already done it in my draft here. So.
Thanks, Scott.
sorry. So what are you
What
gonna
would
add?
it what would it say? Sorry.
In the illustration, we would say whatever the dollar amount they have with a historic cost and accumulated depreciation of X dollar amount are fully depreciated.
Right.
You don't have to say X dollar amount historic cost and X dollar amount accumulated depreciation.
Oh, okay. Okay. Yeah, because trying to modify paragraph 11. No. And I can see some people just reading the first sentence of paragraph 11 and saying, oh, we only have to do that for those that exceeded 80%. And they're not thinking about fully depreciated. I think that's the best approach, as Scott has described.
So, Jeff, in essence, we've not solved your problem, but we've avoided the confusion of your problem by fixing the illustration and adding those couple words. What your point is, we don't really need to disclose that. It's not essential but at the expense of it's an easy additional disclosure because it's a couple of words, and to avoid the confusion of messing with paragraph 11 to distinguish it, we're just going to keep it as it is, I think is what it seems like a majority of the board wants.
Yeah, I mean, we've eliminated the inconsistency, right?
Right.
So, and at least in doing that, you've made it a little bit a little bit better, and I understand the desire not necessarily to try to have to wend it into paragraph 11. So I think it gets me there.
Very good. Any other comments on that or anything else on paragraph 11? All right, thanks everybody. It's an important paragraph. It's important additional disclosure, so I appreciate the good discussion on it. Scott, we can move on. So I was thinking about a break, but maybe we just wait till around noon for lunchtime and we'll just break then. All right, we can keep going, Scott. Scott, I don't know if you said anything, but you were muted. So are we doing paragraph 12?
I did say I was talking to myself, obviously. Sorry about that. And yes, any comments on paragraph 12?
Thanks, Scott. Any comments on modified approach, paragraph 12? No.
Okay, moving on to paragraph 13, you'll notice we added the first sentence to be consistent with the note disclosures that are being required are by network of assets. And so we're carrying that through to the RSI disclosures to not have them be at a, different level of information when they compile that information. So are there any comments on paragraph 13?
Thanks, Scott. Any comments on paragraph 13? We're good on that one.
Okay, paragraph 14.
Comments on 14? Do not see any, Scott.
Okay, paragraph 15.
Comments on paragraph 15 on the supplementary information. No thoughts there.
Okay, moving to the last section, effective date transition, paragraph 16.
Everybody's waiting for paragraph 17, but before we get there, anything on paragraph 16? We're good on 16.
Okay, paragraph 17.
Any board comments on paragraph 17? Diane?
So do we want to talk about the transition provisions for paragraph 7?
Yes, let's. So I think that it has come to light to me, at least, as we have gotten comments and I was going to say discussion, not discussion among board members, but me talking to the team talking to board members, and et cetera, that I think there's we don't all agree on what we meant when we decided on the transition provisions related to paragraph 7, which is the componentization. There's kind of two main schools of thought, because what we wrote is that those provisions should be applied to infrastructure assets acquired after the beginning of fiscal year beginning, essentially after the beginning of the year of implementation of the standard. And so when we said infrastructure assets, kind of almost to our prior discussion, what did we mean by that? And some of us, I would put myself in this camp, thought that meant anything that was acquired, any I'm gonna see, this isn't the right, whole infrastructure asset, not a new replacing a component of an infrastructure asset. And I'm gonna have to come back to this because we've kind of changed what that means maybe. Not component of infrastructure asset acquired after implementation is when you would componentize. If I replaced a component of an infrastructure asset after implementation, that's not, we didn't have to record that. Other board members clearly thought, no, that acquisition of a replacement of a component is a new infrastructure asset. And that is kind of what the language now would tell you. And so that componentization, that transition provision kind of starts immediately for the surface of the road. Whereas in my world, you're going to continue to replace the surface of a road that was acquired 10 years ago and not change anything. Keep accounting for it however you used to, as long as you're not double counting it, which you never were supposed to. Versus in my world, I would keep doing that. I won't say versus. In my world, I'll keep doing that and only componentize any new whole roads that are added, not components of a road. Not everybody agreed with that, but that's what I thought. So given our new words, we have to figure out a fix because we got to probably change something. Well, maybe, but I guess in theory, not on the words themselves, but in theory, in those two scenarios, what did other board members mean or want, I guess, when they voted for or against, I guess, that transition provision? Hopefully I explained that kind of well. Diane.
Well, since Jackie and I wrote the alternative view on this, I'll jump in. My understanding was that what we were doing is making this prospectively, because that's what a lot of the stakeholders had responded. Don't make us go back and take a look at all of our existing infrastructure assets. Instead, make it prospective. So I didn't think there was a designation or a differentiation between the component piece or the asset as a whole. Just going forward, you will look at everything under the lens of components. And so if you just do the resurfacing of a road, then you would be looking at that in terms of what was that original cost of the original road, and is it a component or not? And that's actually how I wrote the alternative view and had Jackie's input on that too. So that was my understanding when we made these transition provisions.
Thanks, Diane. Jackie.
And that was my perspective on it too, was that if this was a significant component, big enough that we were going to identify it, then yes, we needed to identify it and break it out and look at the asset basically from that point forward. So yeah, my perspective was the same as Diane's on it.
Thanks, Jackie. Chris.
I would just say that's consistent with what my understanding is as well.
What Jackie and Diane described.
What Jackie and just described, I just didn't
Okay.
move to that level. Yeah.
Thanks, Chris. Robert.
Okay, I need to see if I understand what they're saying. So if you had, again, we're using the surface of the road versus the bed. So is your opinion, Jackie and Diane, that upon transition, that surface of the road needs to be componentized, or only when you replace the surface of the road at a future date?
Diane, sorry.
So I know we look so much alike. So my understanding would be that, like, once you implement this standard, then anything going forward, you're going to look at it. Is this a component? Is this of that asset? So if you're going to resurface the road, then it would be after you implement this, and then you would take a look at that cost and determine if it's a component. I do want to throw in too, if we are just going to narrow this down to just apply to entire assets, so the entire road or the entire water system or the entire wastewater system, it's just going to be so minimal by the time you ever have any components come up, because those things don't get replaced like that very often. So I just wanted to throw that in too.
Robert, did that help you? Like essentially,
No,
it was
no,
like
I'm
not
still
every
too-
road,
Yeah,
not at transition everything, but when at whatever point in time you replace the surface, that's when you would have to kind of do it.
well, that's the way I was viewing it. It was, I mean, that you don't, at transition, you don't have to do this. You, when that component, and if it's significant of this bigger infrastructure asset is replaced, 10 years after the standard is implemented, then you have to make this assessment and at that point in time potentially componentize it. That's the way I understood it. And am I understand, Jackie and Diane and I guess Chris, is that where you're at? Okay.
Chris?
But I guess the concern in thinking through that method now is, how do you break out that component, because you don't have that historical cost of that component because you never tracked it that way in the past. So in order to not double count, you have to pull that piece out in order to add the new component piece. And so how would we really accomplish that is the concern that I think for me that Diane and Jackie are bringing to light, and it's causing me to try to think through or backtrack a little bit on ways that we could accomplish it.
Chris, you just hit the nail on the head, right? Because if you suggest that componentization would only apply to roads acquired after transition, you never have to go backwards. So if you thought about it Joel's way, you would never go backwards. You've eliminated that problem and that cost. Now it is true, less things would then be componentized. There's no doubt about that, but you just eliminated the cost. And so I think Joel thought that's what we had when we had the original conversation. That's what we had decided. We didn't want to incur that cost, therefore do the transition this way. So we've taken a lot of the cost out of the equation.
Jeff?
Yeah, right. But as has been stated, right, I think by Diane, you neuter the effect of this componentization to the point where I'm sitting here going, wow, we're changing accounting 50 years from now, right? Because the only way this componentization ever comes to the fore is you got to replace that road, that water sewer plant that you plan on working for 40 years. Not that you're replacing some giant generator in that water sewer plant, right? Nope, it's got to be the entire thing. So that seems to me to be of really minimal impact. And so the way I see it working is that if you get a new component, so I'm not asking at transition, you don't go back and componentize everything, but going forward, you're putting in this giant generator in your water sewer plant, you're going to have to analyze, is its useful life different than the end? Is its cost significant? And if it is, it becomes an infrastructure asset in its own right. Right? That's the way I saw it working.
Becky?
So I'm going to give you a really good example here of the Jeff result. So we're putting in the Howard Franklin Bridge spans Tampa Bay, goes from the two counties. Huge bridge, huge, massive. So this is what's happening. One of the old spans is staying because it was replaced a few years ago, 20 years ago. The other span is being torn down and completely replaced. So that's one bridge, right? They'll never have to put that cost down if we don't componentize it, because it's still the same bridge. They just replaced half of it, not all of it. So it's still just one bridge, and it's been there. And that's the way they'll do it probably going forward, because that's the history on it. They take down one span and replace it with a new span and keep using the old span until that one's worn out. That one will never get captured based on if we just have to do a completely new asset and move it forward.
So, Jackie, I understand, and Jeff, I understand what you're saying too. At least in the way I thought about it before, but I'm rethinking it right now, especially in light of what we're doing to paragraph 7. But at least before thinking about that, to me, one of the benefits of the componentization that I think is still achieved when this is implemented is I think governments are routinely might be strong, but maybe often double counting, say, the resurface of the road. They've got the original road, they resurface it, the resurface, they'll capitalize, but they don't go back and figure out, well, what was the cost of the old surface that I've replaced and write it off. They don't do that, right? But the current accounting should be don't double count it. Either expense the resurfacing and leave the old surface in the whatever, or as Chris kind of pointed out, it's kind of difficult, but you can do it. Governments do it all the time. I won't say all the time. They at least think about doing it. Of go back, figure out in the same way we kind of figured out at transition what the cost of these roads were. I know what the resurface cost this year. I can deflate the cost, whatever it is. However, I want to estimate what the part of that old asset was the surface, how much it's been depreciated, write off that net book value, and now I can capitalize the surface. They would have that option, or they would know those are their options with anything old. And so I at least, hopefully with this, shine the light on the double counting, and you can't do that. And so I think that's a benefit day one of the componentization, even though if the transition provisions weren't as I originally kind of thought they would. I agree, in Western states and in Southern states where we're adding new roads all the time, there's going to be some componentization, but especially in the Northeast or in major bridges like Jackie's talking about, we're never going to get the benefit of that accounting for those assets. And I get that. And for cost benefit reasons, I was willing to accept the benefit of shine the light on double counting, minimize costs, and in some cases where states and local governments are growing, we're going to get some better accounting, but we're just accepting that the old is the old. That's where I was. And I still can kind of be there, but now we've got, to me, this new layered complication of paragraph 7 or whatever it's going to be describes that once you consider the component, now it's its own asset. And you read these words and it says infrastructure assets acquired. Well, which infrastructure asset? Now I really am going to think more like Diane and Jackie, where that component that I am now acquiring, that road resurfacing, you've told me it was a component, but it became then an infrastructure asset. So isn't that what you meant here? And I would probably either need to change the words here to get to something that I wanted, which would complicate this even more than it's complicated, or live with the fact that the transition provisions are what Diane and Jackie suggested. That means, yeah, when you acquire the new component after implementation, we're requiring that componentization accounting. You're gonna have to figure that out for all of those. So, Jackie.
So, I mean, even though I said what I just said, and my understanding was what I just understood, because Diane and I were talking about an alternate view, I could actually support your concept of what component means, because it would make it a lot easier for the governments to implement, because they won't have nearly as much.
Thanks, Jackie. Diane. You're muted, Diane. Sorry. Those were great words, I could tell, but
Yes, they were great. As I just wanted to throw in that if we don't go to the other interpretation, as Joel had outlined, then it seems to me like we go to the cost benefit issue, and there's just so little benefit there that why move on with componentization? But anyway, just thought I'd throw that in.
I am. Jeff.
And Joel, can I just get a better understanding of, you're sort of suggesting it solves this double counting thing, but if we have your interpretation, my interpretation is governments know that they don't even have to contemplate componentization until there's a new asset, an entirely new asset. Therefore, all this double counting you're talking about, I'm going to continue to do my double counting until that road is completely gone, and it's going to, you replace the road. So you're really not solving anything of double counting because you've turned off componentization until there's an entirely new asset.
Jeff, I guess I'm not solving any past double counting, but I'm solving any future double counting for the new components, the new surfaces that come on after implementation, hopefully by people understanding what the accounting should be if they were required to componentize. They understand, well, I can't double count that then because those are separate assets. And so that asset's already there. They'll understand that concept better, so they'll avoid any more double counting on those surfaces. So that's, kind of in between solving it, but that was what I was trying to articulate.
I think that sounds optimistic to me, though, Joel, right? Because you're saying, think you will be a good guy and will think about what you should be doing 50 years from now and start doing it now. When I'm saying, why wouldn't I just, I'll worry about that 50 years from now. And, I'm not going to I don't even have to think about this component. I don't care what GASB says I need to do 50 years from now. I'll deal with that then and not be a good soldier and do anything different than I'm currently doing.
I'm more optimistic than that, Jeff, and the auditors and preparers will kind of understand, oh, maybe I wasn't doing it right before. I want to do it right kind of moving forward. It seems like we have three options. Maybe only two.
Could we summarize that?
Well, that's what I was trying to do. I was trying to figure out if I have three or two. I know there's at least two. There's one option of almost you kind of leave it like it is. And now, to me, it's probably more clear that infrastructure assets would be, because we've in paragraph 7 said, once you componentize it, create a component, break out, we're going to account for a component, it becomes an infrastructure asset. That's probably what they're going to think this means. And so these words would affect to, I have to break out new components and account for new components that come on, not just whole new assets, but when I resurface the road, I've got to, even though the road was acquired before implementation, any resurfacing after implementation is a component, it's an infrastructure asset. You've got to do this accounting. And so you've got to back out the old one, add the new one, all that stuff. That's one option, which I think probably kind of leaves the words as they are. Just I now have a better understanding of them. Or we try to change the words. I don't know exactly what we change them. Try to change the words to be what I originally thought they were, which is somehow, without calling them infrastructure assets, we say, you don't have to, any asset or component of asset or whatever that existed at transition, you don't ever have to change anything of accounting wise related to that moving forward, including breaking out the components. Just when you have wholly new built assets, that's when you would apply paragraph 7. We'd have to find the words to say that. That's an option. I don't know if there's a third option, but I guess a third option is retroactive still, but we've already kind of, hopefully we've already said no, we didn't want to do retroactive. So essentially maybe we have those two options. Do we fix the words to be what I originally thought that seemingly nobody else thought? I'm the one that was the outlier. Or do we kind of think these words describe what you all thought now that we've, and I just understand it better. And we love it this. Chris.
So I agree with you. I just want to make the point. I know Diane spoke earlier about the cost benefit. I guess for me, just for putting it out there, I don't know. I don't know that analysis is not already made in my head because I don't know like the cost of pulling that together in the way that you described, kind of taking the number as is today and going backwards in order to figure out what that historical cost that I'm going to take off my books before I add the new cost on. I mean, it does sound like it could be a lot, but maybe there are certain ways that you could do it where it's not that big of a burden. So for me, at least, I guess I'm just saying, I don't think that it's an automatic that if we choose that method, that it's an automatic no, because now it doesn't meet the cost benefit assessment.
Jackie.
So I'm going to go with changing the words. The big surprise, right? But to me, that would take care of my concern with them having to go back and break out components. But I think it guts what Jeff would like. But to me, it takes care of my concern about the cost of actually having to figure out what you've already got and whether or not this is going to be a significant component.
Thanks, Jackie. Chris.
And just to kind of finish the thought, I am a little torn because in the one method, I struggle to find a more immediate benefit. Not to question that there's no benefit, but I struggle to find a more immediate benefit. And then in the other method, I can't really put my thumb on the overarching cost to do it. And so both sides are dealing with the opposite here. And I'm just having trouble struggling to figure out which way would be overall better.
So Chris, if it helps, I do think I'm going a little bit from memory, that so maybe Scott or Alan can either affirm or question this. I think there are some implementation guide questions dealing with both transition and estimating historical cost and deflating and using current cost, combined with some questions about the composite method. I know if I'm remembering, there's an implementation guide question about the composite method that says what happens when you get rid of part of your asset or one of the assets that is making up your composite, and it talks about how you would break out, how you would estimate what that historical cost was, what that piece was in order to write off that old things. So I think there's some implementation guidance that should help governments with the calculation that I described. I don't know if that helps you, Chris. It doesn't make it easier, but I think we've already got some built-in guidance that we could reference people to help them with it.
That's fair. And I think whether it's how it would play out or not, I do think that the concern that Jeff raised about individuals just ignoring everything until they get a generation out is important. And so I think that way we combat that through keeping the language as is and the interpretation as I think the majority of the board understood it. And just pointing people, to your point, Joel, over to that guidance that's existing right now and the ways that they'll have to go through it and seeing if it is a bear for them to get through or if it's reasonable.
Thanks, Chris. Jeff.
So building a little bit on what Chris was saying, I think here for me, the Goldilocks is an apt analogy here. So we got a bed that's too hard. And that to me is retroactive, right? Making governments go and crack open all of their existing. So I recognize that probably seems pretty hard for governments. That's too hard. On the other side, we got too soft, which is you don't have to do anything until you get new infrastructure assets, however many years or a generation down the line. That to me seems too soft, right? There's just you're neutering the benefit of this componentization. So to me, the one that's in the middle seems appropriate, right? You don't have to go back and break everything out, but if you do create a new infrastructure asset via even a component, then you got to do the disclosure, because the purpose of componentization, right, is to make your depreciation more accurate, right? And the sooner we can get that benefit going within a reasonable burden, I think is a good route to go. So that's why I support, I guess, where Chris is at, which is leaving the language alone.
Thanks, Jeff. Diane.
I would also leave it alone. I think that I think Jeff's analogy is good, and I do think that there's just no benefit on changing it to just be the entire replacement. So I would leave the language as it is.
Thanks, Diane. Robert.
I'm comfortable leaving the language as it is. I'm still not completely sure of the distinction between the two options, but I would agree with a comment that Chris made several minutes ago about the issue of, you know, going back and figuring out what's going to be retired. And I know that's part of what we're talking about here in the last couple of minutes. I think that could be difficult, but I also have a suspicion that many of those assets likely would, whether they have done what they should have, governments should have been doing what they should have or supposed to be doing all along and looking and periodically at the useful lives, that the net book value is going to be negligible. And so I think that likely will mitigate some of that, the double counting. It doesn't, but going forward, I think I thought it was clear, and maybe I wasn't thinking deep enough on this, but I would agree with keeping the language as it is.
Thanks, Robert. Carolyn.
I really relate to what Jeff and Chris were saying. I think the other option will probably not give us a lot of meaningful information in a timely manner. So I agree with keeping the language as it is.
Thanks, Carolyn. So I was the outlier. I think it seemed like everybody else kind of understood it to be what it seems to have become, but from a majority of the board. The reason I think if I remember correctly, I voted for the transition, even when I thought it kind of really took a lot of the benefit out, but it was cost, right? And so as I think about this, I worry about the cost because this is certainly more costly than I was thinking. But and so I was kind of on the fence last time, but I voted for let's minimize the cost. And I still kind of want to do that, but given the unit of account discussion we've had this morning and everything we've kind of already decided, on balance, that's kind of flipped me to let's just leave this language the same. It's more costly than I was originally intending. But I think that versus mucking up the language more and trying to figure that out and coming to something that sound like other board members don't see some of the benefits I do, but although I agree it's not, I guess I will come down with the majority of the board on let's leave this language the same, and its result is maybe different than I originally intended, but I at least understand it now, and I've come around to the way all of you are thinking about it. So we'll just leave it the same, and it means something different than I thought it did, but I think it It's probably the best answer at this point for now. Okay, so that's paragraph 17 a bit. I actually have something I kind of wanted to propose about paragraph 17 and transition provisions. I think it's probably a good time to break for lunch as opposed to getting into that discussion. I'm just questioning whether I throw it out there so that you can think about it over lunch or not. But I had Chris is shaking his head. Yes. Alan's going, nah.
I just meant we won't get through it, but throw it out
No,
there.
I know we're not
Throw it
getting
out there is
through it.
probably a good
It's
idea,
just,
so they know what
All
you're
right.
going to bring up. That's probably fair.
Okay. I'm just gonna put it out there. So be mulling it a little bit during lunch and then we'll discuss it. But as I have been thinking through the implementation of the standard and the prospective nature of paragraph 7, the estimated useful life. No, 6, not 7, sorry, not 7, 6, which is the periodic review of the estimated useful lives and the prospective nature of adjustments that might create, with our understanding that the pre-agenda research showed there are many governments who have a lot of fully depreciated infrastructure assets that they are still using, which means they really haven't been periodically reviewing the estimated useful lives along the way. And that's why we've emphasized that requirement that's been in category B gap for a while and brought it up here because we know people aren't kind of doing it, or a lot of governments aren't doing it, and we think they should to get depreciation to be a better number. When you think about the prospective adjustments that will or won't be made for all those assets that have been fully depreciated, as our research showed, I just really continue to be a little worried that depreciation expense is going to be a long time before it gets any better. It's a better reflection of true depreciation. And so my proposal that I'd like for you to mull over at lunch is that at transition, we require governments to do their review of the estimated useful lives of all their assets at transition. So we've said periodic, which means you got to do it at some point. Maybe you should have always been doing it. Let's do it all at transition, which shouldn't be a big deal. But here's the kicker, but have them adjust their beginning accumulated depreciation and beginning net position to retroactively reflect what accumulated depreciation should be for all their existing infrastructure assets using the new estimated useful life number as opposed to whatever they were using before. Normally, when this change in estimate is a prospective adjustment, not a retroactive adjustment, I'm suggesting to kind of reset us all. Let's make governments retroactively adjust beginning accumulated depreciation and net position for whatever depreciation should be using their new estimated useful lives. Boom, bomb dropped. Let's go to lunch. How about 45 minutes? Or do we need an hour? 45 minutes. 12:45-ish, 12:48 maybe. Eastern time. See everybody back and we'll pick this up. Thanks. All right, welcome back, everybody. Hope you had a good lunch. And I'm sure you spent all the time thinking about infrastructure assets transition. So I will reiterate kind of my proposal, because I know it's kind of new and not one we talked about before. And then also see if anybody else has anything else on paragraph 17. I don't want to, this isn't necessarily the final thing, but in rethinking or continuing, I guess, to think about what prospective means and really thinking about the benefits of paragraph 6 and periodic review of estimated useful lives, and really what is depreciation expense reflective of? I know from talking to, and we've heard from talking to users, they use depreciation expense in some of their metrics and indicators and ratios. It's a pretty important number for them. And if governments have a lot of things that are fully depreciated infrastructure that they're still using, which our research showed that it exists pretty prominently, and we've heard that a fair amount, that depreciation expense, even moving forward with periodic review of estimated useful lives, if the adjustments are prospective, isn't really fixing necessarily anything. And maybe the best way to do that is just for transition to ask everybody to do their review of estimated useful lives that year, their periodic review, what happened in the year of transition. And then whatever adjustment they have would be actually a retroactive adjustment. So they would, for that provision only. So if they, come in and figure out that that fully depreciated road really has, instead of a 40-year road like I thought it was, is really an 80-year road, then I go back and at transition adjust what a beginning accumulated depreciation should have been if I depreciated that road over 80 years from the beginning. And then the offset would be to beginning net position and make the retroactive adjustment. To me, that resets all of us at a better number for accumulated depreciation. And then moving forward, the depreciation expense would be a better number. And then if you're periodically reviewing your estimated useful lives, then anytime in the future where you make that adjustment, we still would do the prospective, the way, you would always have thought we would for a change in estimate, because at that point, it shouldn't be a really big change. It should be, only the change that's happened the last couple of years or whatever it's been since my last periodic review shouldn't be that big a deal. So I don't think we have to make any changes wholesale in how you might think about changes in estimates, but for this transition only, it seems like a good idea to consider. So I'm interested in what you all think of that idea. Chris.
Joel, just a quick question. So for components, how would you handle them with the accumulated depreciation? Like, are you breaking out yet that major infrastructure? Like when you do accumulated depreciation, are you then breaking it out into components, or you're just leaving it as the big thing?
I'm leaving it as the big thing until the point in time, based on the other transition provision that we just talked about, until you then, changed out the component. Now you deal with it the way we talked about before lunch, but at transition, you're just dealing with whatever you have then at the beginning of that year, whatever it is in condition it's in as a whole thing, you would just do the whole thing at that point in time.
Okay, the only thing I'm trying to think through is if you were to do something like that, given that we have people thinking now about components, and I actually think they do make a lot of sense and I like them. How do you then redetermine for this larger infrastructure asset what the true useful life is if it's made up of a 30-year and a 50-year and a 60-year and a 25-year or something like that?
Guess however you've been doing it, right? I mean, you had to set some original estimated useful life for that combined thing before, and whatever you would think that is now. Jackie.
So I have another question that I'm kind of interested in this idea, but how do you envision it flowing through the financial statements? Because this is going to create a change in your net investment in capital assets. But somehow the adjustment to the expense, it's not going to be an expense, it's going to be a gain, probably, because you've overstated your depreciation expense in prior periods. So your net investment in capital assets is going to need to go up. So how do you, and the reason I'm asking that is because if they do this all in one fell swoop, that could be a pretty big bump that you're going to see. Going through, and I'm assuming it'll have to go through the flow statement so they can articulate.
I would envision it being a restatement. That beginning of the year net position would be adjusted as well as beginning of the year accumulated depreciation. So it wouldn't flow through the flow statement. But I agree with you. I think it will probably be a pretty big number for a lot of governments.
Okay, so you're just seeing it adjusting to net position directly, moving out of the unassigned, unrestricted into the.
And essentially almost a retroactive implementation transition as opposed to prospective for the periodic review of estimated useful lives. We're going to restate the beginning ballots of the year of implementation.
Okay.
But you're just characterizing it as a change in accounting principle,
Correct.
not a correction.
Because you're implementing this standard.
Not being construed as correcting an error.
Correct.
Okay. I thought Chris had a good point. I think some people might be confused. Again, sitting us talking here and whoever's watching, we might understand that it's the big number, the big infrastructure asset, not the components. But I think some people might be confused that they're going to have to do that on the more granular. But I don't know. Thinking.
Jeff.
Well, that's going to depend, Joel, right? I mean, I think we'll have to write paragraph 17 well, right? But if we succeed in that, right, then Robert's concern, I think, should be taken care of, right? Because you're still going to be in a world where this only applies if you got a brand new infrastructure asset or component. If at transition, you're not dealing with that. You're just dealing with your existing portfolio of infrastructure assets, then none of this retroactive. You're just going back and sort of resetting your depreciation, but you don't have to worry about breaking anything apart. It's just at your infrastructure asset level, right?
Right. I mean, it's kind of specific, but if you look at the transition provision that exists currently for paragraph 7, it's applied to infrastructure assets, which we know means the component, right? Infrastructure assets acquired after the beginning of the year of fiscal year beginning after June 15th. So that would be any component or otherwise big asset that I acquire after the beginning of the year. If you write this transition to be kind of as a sentence before that one, to say, retroactive to the beginning of the year, which wouldn't include any of the ones after, I make this adjustment, then to me, on a timeline, you should be, okay, at the beginning of the year, not after the beginning of the year, but at the beginning of the year, I do this analysis, make this retroactive adjustment, then I move on for any component or asset I acquire after the beginning of the year. Now I have to apply this componentization. I don't know. It seems like it should kind of be relatively straightforward. It shouldn't be that hard for people to pick up, I would hope, but I guess we could see the words on the page. If people agree with the notion of it. Diane.
So when you first introduced this before lunch, I was thinking that you were talking about just making an adjustment on the years and not retroactively adjusting that. And it seems to me like it's going to be hard for the stakeholders to understand what's going on with that. And I'm thinking like the town council and the legislature and stakeholders like that all of a sudden they see these big changes. And why would we not do that as described in paragraph 6 and just adjust the ongoing depreciation, but have them do it at the beginning upon implementation of this standard?
I mean, we could, Diane, right? That's kind of what the current version of the standard would call for. My concern is that you've got governments that have a lot of these fully depreciated things. And so to an elected official, to a city council member or a bond investor, if that depreciation expense means something, it's a less meaningful number if we know that those useful lives really haven't, I mean, it's been a less meaningful number for years, is kind of what we're saying, because we know governments haven't been adjusting it. And so why have it continue? So a little bit of the same conversation we had about the componentization of we're neutering the benefit of making depreciation expense better if we just do it prospectively. Whereas if you want the big bang benefit to have depreciation expense really be a more reflective, better number, then you would do this retroactive part, right? So it's kind of a little bit like that last conversation we had about componentization. I think we're minimizing benefits by only doing it moving forward. And if we just do it at transition, we don't kind of affect the way people normally account for those changes, but we get all of it kind of done at once retroactively, and we start from a better place. Jackie.
So the stakeholders that Diane mentioned made me think about something else, that maybe in fact many of these assets really are fully depreciated and they're holding together with duct tape and baling wire because they're trying to convince their elected officials that they need to be replaced. Now we come in and say, well, you're still using them, so you got to change the useful life and depreciate them. I don't know if that's a true reflection either of the value of the assets. So, interesting question here. I think they're somewhere in between probably, but I don't know how you get there. But I do have a concern about that some of these assets really shouldn't be on the, they really are fully depreciated and they really should be replaced. But sewers are a good example, right? Until there's a backup in somebody's house, nobody's going to replace them because they're not sexy investments. So
yeah. But Jackie, that's just a reflective. You've got to do a good job of estimating what the real useful life is in your periodic review. So in that case, even at transition, if I thought it's only going to last a couple more years, then I don't have much of an adjustment or even a material adjustment at all. So as long as you're really appropriately periodically reviewing or reviewing that estimated useful life, that shouldn't affect what you're doing here, right? I mean, that the concern that you had shouldn't.
Yeah, I think as long as they're clear that we're not making them, if they're still using it, and we're not making them extend the useful life because it's still being used, rather it's whether it needs to be extended.
Yeah, I mean, hopefully that's it, and kind of currently exists in paragraph 6 that the periodic review is they need to be real reviews and real best estimate we have of how much longer this asset has based on its current condition, the upkeep we've been doing or not doing, all that stuff that we kind of have egg questions that talk about things you should consider, but say it should be a true reflection of what you expect your asset's estimated useful life to be. Chris.
So in my head, I'm still getting caught up a little bit on the decision that we made right before lunch, as far as how we wanted to move forward with componentization and really looking at all the things that are absolutely new versus portions of an infrastructure asset that we're swapping out in our decision there. I think that in my mind, at least, if this was the alternative, the other option, then I would completely be okay with this idea of going back and adjusting the accumulated depreciation. But I'm having a hard time in my mind with us saying, this is so important that we want you to, when there's a new component added, look back and retroactively figure out what the related cost and accumulated depreciation is for this. But on day one, I do understand this transition provisions, but on day one, we don't want you to do that same thing in this other exercise of re-evaluating your estimated useful life. So, I feel like we're doing two different things there. So while at least what I'm struggling with right now is while I would have been a lot more okay with it under the other circumstance, I'm having trouble reconciling it in this circumstance.
Yeah, Chris, I mean, effectively, we've had for cost benefit reasons, we've had prospective implementation of the componentization aspects, but we're having retroactive, I'm proposing retroactive implementation of the review of your estimated useful life provisions. And you know, the best accounting, if the standard we're proposing is the best accounting, then all of it should be retroactive. Like that's going to affect the best application of these standards. The reason we did, you know, this prospective, or the version of prospective that we discussed prior to lunch for componentization, was really for cost benefit reasons, to not make you go back and redo all of them that exist at year end. We're going to do it as you replace components is when you would have to do it, or you add new assets. So, I mean, I see the point a little bit, but I wouldn't, you know, as it currently exists, we kind of got prospective and retroactive in the both.
Yeah, I guess I just feel like we're asking to adjust those assets, and then we turn around in the next year and we purchase something new, and I'm just trying to think through related to that specific asset, right? Where we just changed the accumulated depreciation, allocated it out over the course of the infrastructure asset, but maybe that component was the real thing that, you know, was weighting one way or another, but we're not truly accounting for that because we went and we did something before we brought in that new component to recognize. So I'm just like, if it's one step too far is what I'm just struggling with.
Guess I would argue you've restated as of the beginning of the year the best you know for that asset that existed, and then either way, when you replace the component, you've got to go back and figure out how much of the old thing do I write off? What's the net book value of the part of the old thing that I've just replaced? And now it's just that net book value is going to be a different number than it would have been if I hadn't made you go ahead and periodically review the estimated useful life. I kind of sort of hear how much of that component went into your determination of the estimated useful life. And I guess I would argue you did the best you could as of the beginning of this year at transition of thinking about that asset as it existed in your system and determine an estimated useful life moving forward. And then part of this is periodically reviewing the estimated useful lives of all your things. So at the time you added this new component, you rethought it and you went, well, now the rest of the thing, because now I've replaced this, has a different estimated useful life. Well, now I update it again then, but I'm applying it prospectively because we're not making retroactive application for any change in accounting estimate that you have. And so I would say, well, now you just apply paragraph 6 as it exists, not its transition version, to the rest of the asset now that you've got more information because you replaced part of it and you think about it differently. And that's okay. I mean, I think you could consider that. Jackie.
So I'm going to support your suggestion. I think that it's probably a good suggestion and worth them considering. I think it's a good stake in the ground moving forward on this with infrastructure. The one thing that I probably would ask us to reconsider is the timeline for this. If we're going to ask them to go back and re-look at all this, they're going to have to drag in engineers and everything to do all of this at one time. And some of them have a lot of infrastructure assets they're going to need to look at all at one fell swoop on this. But I think I like the idea. I think it probably has value. And this is an exposure draft, so I think it's worth considering.
Thanks, Jackie. So when you say timeline, you're talking about the amount of time until implementation.
Exactly. Yes.
Thank you. Okay. I can understand that. Sure. I get it. Because whereas before we said periodically review, and that's the new requirement. Does that mean you have to do it all in the year of implementation? Doesn't mean you have to. I would kind of argue if I had an audit client that had never really done it, I'm probably going to want you to do all of them at one time, but not necessarily. So I wouldn't be opposed to considering a little bit longer implementation period. But to your point, we can hear the feedback we get from the exposure draft and make that choice later. But I would certainly rather give them more time and have a better result than impact the result because we just want it to be a year or 6 months sooner or something like that.
It is
Jeff.
true.
Yeah, Joel, just to clarify, maybe to extend what Jackie was talking about. So when you're talking about it, so what the government would do is that when they first apply the standard, that's when they would go and look. So paragraph 6 has this notion of periodically, right? That's not going to change, right? Periodically is going to remain periodically for going forward purposes, right? But at transition, when you first take on this standard, you're in effect going to apply paragraph 6, right? And then in addition, you're going to look at it as to make these adjustments in your depreciation, as you were talking about. And depending on, which may be a discussion, I don't know, for another day or whatever, like how you think Statement 100 handles this, right? You're saying this adjust depreciation would be a thing you would do only at this implementation. In other words, when you later on periodically adjust and you end up adjusting, extending, let's say, a useful life, you wouldn't adjust the depreciation at that time. That would just go because that's prospective, and until we decide differently, prospective is you don't do whatever you want to call it, a true up or an adjustment at the change year. You would just flip it, and going forward, change your depreciate, whatever you depreciated to date, you would just change to whatever you're going to depreciate going forward. Is that correct?
Yes. The moving forward periodic adjustments you do after implementation would be applied prospectively with how you would interpret Statement 100 to apply prospectively. But this retroactive would be a different way. We would be specifically telling you, not prospective, retroactive, adjust beginning balances for the change you identified.
Yeah, I mean, I'll say now that I think I'm with Jackie here in supporting this because I think it helps to deal with something I've been struggling with, right? Is, if you've got a depreciation at a level and then you change your depreciation, as you say, right, there are a lot of users who look at that depreciation and apply that to come up with a percent depreciated metric. And if that percent depreciated is off, right, their analysis is off, right? And that's a pretty important part when you're thinking about capital needs of that analysis. So if this is a way now we can get that to be reconciled, right, to, okay, and I agree with what we were talking about before. We're not saying you have to go and extend. If it's legitimate, my understanding, if it's legitimate to extend your useful life, you will extend it. If Jackie's bridge is being held together with wire and whatever, then you shouldn't go and extend it, right? Because that thing is literally legitimately past its useful life, right? But for the things that, well, we may have, been a little too conservative with our estimated useful life, and maybe this thing should be a little bit further out. And for those, then we go and reconcile to what we should have depreciated over that new useful life. I think that will be a very helpful thing when they adjust to this new standard, helpful thing for users.
Thanks, Jeff. Diane.
I have a problem with the retroactive part. I just don't like having to go back and recalculate all of that and adjust the books accordingly. I would like to see it. I don't have a problem with them reevaluating as of implementation date. And in my mind, I'd like to see it paragraph 6, you do that upon implementation and then periodic going forward. And so I don't support the retroactive part.
Okay. Thanks, Diane.
I'm sorry, Diane. What did Diane, you said you do what at implementation? You go back and do
Paragraph 6, that periodic review, that upon implementation, you would do that review. So you would make all of those adjustments prospectively. You wouldn't do the retroactive adjustment that Joel's been talking about. And then going forward, you would have periodic reviews. But it kind of sets that stake in the ground upon implementation for what your depreciation should be or what it should look like, and you've reviewed that.
But what the result of that, though, Diane, right, is that if governments truly do have a lot of these infrastructures that are fully depreciated, but they're still using them, which our research has showed there are, there's nothing moving forward. Like it's zero. It's already zero, and it's not going to change. And so depreciation, the fact that I might use that road for another 20 years, that's never flowing through any of the results. And then if we retroactively adjusted it, which is kind of at that point just like you've done the hard part and analyzing, determining what the useful life is. The rest is kind of within my capital asset system. I just do the program and I just come up with the journal entry, right? And so I would say the hard part, the costly part, you're okay with. It's kind of just the reflect of the numbers that you don't like, which I can appreciate, but it kind of bothers me that depreciation is much less meaningful moving forward, especially with those kind of fully depreciated things, which have nothing left to depreciate.
I get that.
Thanks. Carolyn.
This did provide for some very interesting thinking over lunch. But based on the conversation, I like the proposal. I like the fact that the stakeholders will be getting I'm going to call it the true up information sooner than they would as currently proposed. And I'm always typically going to be a proponent of, okay, if we can get the information out there sooner and people can make have better information that they're making decisions on. I know we'll get some interesting feedback, but at this juncture, I do support the proposal. I think it's a step in the right direction.
Thank you, Carolyn. Robert.
I'm waffling. I get what Diane's saying, but I'm having trouble reconciling. If we required, we said you had to do paragraph 6 upon implementation, and people really did it, wouldn't you have something running, potentially significant, running through the flow statement in the year of implementation? Potentially. If we want to get this true up done, I'm probably coming down on the retroactive side of the fence. I think, regardless of the capital asset system, of the size and type of government, I think that the people, if you have the city, that how they do their roads, we did the roads in 2019, 2020. They, actually, you're talking about going back, decades before that. I think it won't be that onerous, because if those roads if they assigned a 25-year life and we're now in year 33, I think they'll be able to figure that out. I think Jackie had a good point, though, about larger, more complex. It may take more time. I'd be a little concerned. And I also, this obviously is something new that wasn't in the PB. I'd be interested. I want to hear what people have to say. Oh, where'd this come from? And some may say, oh, no big deal, and others are going to, say it is going to be a big deal. So I'm probably on supporting the proposal and doing it retroactive.
Thanks, Robert. Chris.
Yeah, I'm where Robert is. I think I had different concerns than Diane, right? Diane was concerned about the application of the change and how that might impact us for that retroactive look. Whereas I think part of my concern, as I think more about it, is also just in the amount of work and the effort that might be necessary. Like I've just trained my brain over the course of this project to understand that infrastructure assets are more than meets the eye, right? Like the big transformers, right? It's multiple little ones potentially inside of a big one, and the implications of that with different useful lives and how we need to be considerate and understanding all of those. And then I'm then being told in my brain, but for this purpose, don't do that and just look at it um, as a blanket. And but it seems like there would be a lot of work that would go into it. I'm not familiar with assessing infrastructure assets, so it's just completely an assumption on my part. And while I understand that we don't issue trial balloons, I think that to Robert's point, it's very important to just hear the feedback on this because Joel, I do think what your proposal has is value in trying to get at the right number as quickly as possible. But while I do have this concern about the cost for getting it at that right number, putting aside the volatility that I talked about, at the end of the day, there's volatility, arguably, but it's all in getting at a better cost, right? Yes, it might move up and down if I'm talking about making these purchases of key components in the future, a year or so off, but it's all in just right sizing it to get so I can feel comfortable there. I think my biggest space of discomfort is just in how much would this cost for somebody to do, people wise, time wise, energy wise. I like Jackie's proposal of stretching it out so that in implementation is not that you have to have all of this done on day one, but that there's some sort of grace period, whatever. If it's I don't know what it is, but I think I'm more comfortable with that and just seeing what the feedback that we receive specifically related to the cost and the burden in doing it, if there is one. And that's where my focus is. So I'm okay and I can support it, but it's really for me going to be about the feedback that we get back and if there's a concern about that cost or that effort.
Can I ask a question? I'm just curious. We're going to get feedback that's a high cost. Let's predict that now, right? We're going to hear that. But they're telling us there's a high cost to something they should already be doing. And does that play into your mind at all? So theoretically, this requirement in 2015-1 has been there for a long time. You're supposed to be periodic reviewing these. So whatever cost it is, you should already know it because you're periodically incurring it. And this isn't anything new. We're just saying, I want you to true it up. And the true up's not really where the cost is. I think it's where the analysis is. So does it not bother you that the people that be complaining this is hard would be the people not doing what they already should be doing?
I get it, but at the end of the day, the reality is we are where we are, and cost is a significant driver for governments and being able to afford to implement this. Like, I think you're right, right? Like, yeah, you should have been doing it, but when you're in a space where now I'm telling you you have to do it, and you're saying it's going to cost millions of dollars to get engineers in there to do that, and we don't have the budgets to support that, like, what are we supposed to do? And there are solutions to Jackie's point of stretching it out and putting forth the plan, and maybe that plan encompasses over the first 4 years you have to touch everything, or 2 years or whatever. So I think there are ways around it, but I think it would be I wouldn't want to just be deaf to the fact that if the cost is that significant and we hear it universally, I think we would have to consider it at least a little.
Jackie.
I do agree that they already should be doing it, and they may already be doing it, but we're asking them to do all of it at one point in time, and it's all going to have to be looked at the one point in time. So that even if they have been doing it, we're still asking them to look at it now. So that is going to be an additional hit to their budget that they're going to have to consider, as Chris points out. So cost is a valid concern, and yes, they're going to say it. They'll say it every time, no matter what we're asking them to do. But I think it is something that we need to take seriously, depending upon what kind of information they give us back.
So Jackie, do you give them longer to do it all, or do you give them a longer time for which to do it? In other words, you delay the effective date a couple of years, they have more time to do it. or once it's effective, kind of like modified approach a little bit, where they have to do assessments over a 3-year period? Is it once it's effective, you give them 2 or 3 years to have reevaluated everything and reset everything?
My thought was to give them more time to before implementation had to occur. But Chris's idea was a staggered time period, and I could look at either one. I think that some of the effectiveness goes out if we do a staggered, but we may look at it for depending upon what size your assets are, right? The implementation date changes depending upon what size your infrastructure assets are. Not the size of the government, but the size of the infrastructure assets.
Right, because you could worry if you worry about delaying the effective date, that's just people just delay actually doing the work versus make it effective and give them more time to do it once it's effective. In other words, like a staggered roll-in or something.
Right.
Or
Either
you have
way,
to reassess them all after a 2 or 3 year period, you have to reassess them all. So
right.
you have time, you have more time once it's effective. I'm just
So,
throwing that out there. I don't know. We haven't really got to that
to
point
some
yet.
extent, that'll depend upon what we hear back, I'm assuming, but.
No, but it'd be partially good to know whether or not which one of those we're proposing in the words to the ED to know which, right? It's like, it's one, because if we go along.
You're right, because they're
it
not going to
looks like-
think of the alternatives otherwise.
Right, because it looks like we probably have enough support to do what Joel's proposing based on I was tracking it. But now the question is, okay, so we want to do it, you want to do it all at year one? Or do we stagger it by government size, or do you give them a range of time to do it? Almost like we transition to that question now. And Joe, I know that wasn't what you first brought up, but other people kind of alluded to it.
Alan, I would say I would just, if you think it takes them 2 years to do it, then I would add 2 years to the implementation period. I would rather governments all do it at once. I certainly don't want adjustments to the beginning balance of net position every year for 3 years because they did some of it 1 year, some of it the second year, some of the third year. They need to make the whole adjustment all at once. It would bother me a little bit if we wanted to stagger it by size of government or amount of assets. I guess I could see that a little bit because the market's dealt with that before. But at the same time, if every government is having all these adjustments to beginning net position, the market adjusting to that all at once is going to make a lot more sense than, well, we got the big governments this year, we got the small governments, the following year, whatever. To me, it would be cleaner to just, if they're going to need more time to do it, to get all that done, let's just give them more time, but then still do it all at once would be my proposal, which would mean we wouldn't have to necessarily change language in here. We'll just see what kind of feedback we get, and then we can adjust the year accordingly, would be my suggestion there. Jeff.
One other thing, Joel, that I think about is, if given the alternatives that Alan is talking about, I think I would want the sixth thing to happen before. In other words, if we say all the other stuff comes and then you can do paragraph 6 over 3 years, let's say, then in fact, some of your 80% disclosures under paragraph 11 may be wrong, right? Because you had to rush those out the door and we gave you 3 years. So, okay, my year one, 2/3 of my 80% really aren't my 80% because they're actually going to may have longer estimated useful lives. So that's why I'm inclined to, like you're saying, Joel, push, if we think this is a thing, push the whole thing back. Because what's key to running off some of this other stuff is get paragraph 6 right. And then your 80% disclosure and other stuff will be right once that's been, an accurate reflection of your useful lives.
Agree with that, Jeff. Good point. Agreed.
Good point.
All right. I mean, my vote was we had 6-1 on including that. And so Scott, you're good with putting something like that in the transition paragraph somehow or section?
We will craft the board's decision into the paragraph.
Thank you, Scott. Okay, thank you. I appreciate everybody considering that proposal. I know it's kind of new, or it's new, but used stuff we had in there earlier. I really think it's better information, and in the end, if we hear a lot of pushback and want to give them more time, I will certainly be okay with that because I think the result will be much better for, as Jeff kind of pointed out, almost all aspects of this proposal, not just that one provision, right? It affects a lot of what we're doing here and will make everything make more sense and better information, et cetera. So I appreciate everybody considering that. All right, with that, I didn't know, we dealt with the main thing in paragraph 17, then I layered in another new kind of main thing for 17, but did anybody have anything else on paragraph 17 before we continue moving on? Jeff.
Well, I had one thing. So in paragraph 17, so we specifically call out paragraph 7, and we talked about that. Then we specifically call out paragraph 9 and say it applies to the beginning of the reporting period. And I guess that's because we don't want it, if you're a comparative filer or you have prior year's information in your financial statements, we don't want you to have to change that. Given the addition that we've made, the additional sentence to paragraph 13, do we have to include something about paragraph 13 working like paragraph 9? Because paragraph 13 now says you got to break it out by network. And they weren't doing that before. So your prior year stuff, does the same principle hold for RSI in that notion as it would otherwise?
So if I think about this, Scott and Alan, if you applied 100, it would tell you to restate RSI for anything, to agree to the comparative statements, and anything older than that, you don't change. And so in this case, since we're telling you only change the 1 year, don't go back to even the other comparative year, if they follow the logic, they should only change the 1 year and not change the comparative year in the RSI either. So they should know what to do if they apply 100, or do we want to be more specific?
It's a little tricky, because it's a little tricky, Joe, 'cause I think 100 would say only adjust the periods that are in the statements, which could be the current year and if a comparative year both years. The question is, in this scenario, would we not want them to do the comparative year?
I think we would want them to follow what we agreed to for the notes. So I would think, no, we wouldn't want them to do.
I would probably connect those dots and say, well, since you told me only the current year, because 100 clearly says you don't do any of the prior 8 years. I mean, that 100 would get you there. So the question is, do you want to be specific and say, oh, by the way, don't do the comparative year either? It's probably using an old phrase we used to use, belt and suspenders, just to say that here and be done with it. So just there's no confusion. Scott, I don't know if you agree with me, but I think
that's what I was saying.
Yeah.
But the edit would then to just be to bring the paragraph 13 into that same sentence. So it's as easy as that. I would probably just do that. Then that doesn't sound like it adds much complexity and makes it clear.
That's what I think it is.
I don't know if other board members have different thoughts, but I probably think Jeff has a point and we should just do that.
So we just add paragraph 13 to that sentence that references the provisions in paragraph 9, correct?
Yes, actually in both places where 9's mentioned.
Where 9's
Yeah,
referenced.
yeah. But yeah, the key is that sentence.
Okay. Yeah.
Anybody have a concern with doing that or a different opinion? Not seeing any, so okay, make that change. Thanks, Jeff. Anything else, Jeff, or anyone on paragraph 17? All right, so Scott, next would be paragraph 18. Now that I'm looking at 18, this is what Jeff just described. I guess it doesn't change the need for what we just talked about in 17. I guess it doesn't, as I just was making sure. I think we were okay.
because we also have the provision where we're
Yeah.
doing more than just the one thing in 13.
Okay.
There's multiple things in 13.
Okay. All right. So any board comments on paragraph 18 then? Okay. Where to next, Scott?
Okay, we'll go to Appendix A, the background, and we'll take all three paragraphs together, A1 through A3.
Any board comments on Appendix A? Don't see any.
There's a 34 missing in there, Scott, right? Yeah.
Oh,
Okay, move on to the basis then. Anything, we'll do it mostly by section, but some of the larger sections will go by paragraph. First couple are by themselves. We'll do the introduction, paragraph B1.
any comments on B1? Don't see any.
Okay, scope and applicability, paragraph B2.
We already have definitions subheaded in, although it will become maybe a
Wow.
primary header instead of a,
Yes.
it looks like a subheader here, but we'd already kind of done it here, so. Anything on B2? No comments on B2, Scott.
Okay. Moving on to the definition, and of course, any changes we made in the standard section will be reflected in the wording. We'll take this. I guess there's several paragraphs, so we'll just go to this one by paragraph B3.
Anybody on B3? Diane?
It seems like the last time in October when we talked about this, we talked about recognizing that there would be judgment involved and how infrastructure assets are grouped. And we don't have anything in there. I tried to play with it and I couldn't quite work it in, but I was saying something like this definition and judgment will guide how infrastructure assets are grouped into appropriate networks for each government. But I think it's important to, and as we talked earlier today, that the governments make the decision on how they want to group all of that. And so I think it's important to say something like that. I just don't know how to work it in, but I think it should be in that paragraph.
Scott, do you have any thoughts? I would, and I agree with what Diane's saying. If that's not kind of in here anywhere, if you don't feel like it is.
I guess I don't think it's in there directly anywhere. I guess based on our earlier discussion, especially on component, I wonder if maybe that's now a more appropriate, or maybe a place to kind of have a lead into why the earlier decisions the board made today related to component and infrastructure, and maybe that concept is tied in there. But I mean, it applies obviously both places.
Maybe we could give that idea to you, Scott, and see how you could kind of work it in, unless anybody objects that to us talking about how judgment will be important for the governments to use and as they make these groupings. Okay, thanks, Scott. Thanks, Diane. Anything else on B3? We're good with there.
Okay, B4.
Anyone on B4? Just where I start thinking about bingo when we say B whatever a bazillion times in a row. All right, I don't see any comments, Scott.
B5.
Anyone? Jeff?
We don't need to wordsmith it here, but at the end of B5, we introduced the idea of integral and ancillary, which as you recall, we had some long, painful discussions about integral and ancillary. And, I think to most or to a lot of people, those words would seem to be ancillary or antonyms rather to one another. So they don't on their face make sense. So I thought upon reading this, we should add a sentence describing, in effect, why we did that. And I gave a sort of rough suggestion to staff, which I could just mention so you understand what I'm talking about. But the board added integral because they did not want non-essential buildings included. And ancillary was added because they did not want buildings to be the dominant part of an infrastructure asset. So in other words, to explain why we went down this path we did, so, and hopefully help them understand why we settled on where we did with buildings, I thought would be helpful to understand it.
Thanks, Jeff. I would agree. We had a lot of discussion about this. It didn't jump out at me. And when you started saying it, I kind of wanted to just use the examples, right? But I think your description is probably even better. I kind of liked the way you worded that and agree with it. Board member thoughts? I see a number of people nodding their heads affirmatively. But Jackie.
I also agree. I think the definitions or the reasons rather than an example are a better way to include it. So I agree with going forward with an explanation.
Thanks, Jackie. Anybody else? Scott, you're all right with that one? Very good. All right. Anything else on B5? All right. Thanks, Jeff. Keep going, Scott.
Okay. Continue down the bingo card, B6.
Anyone have B6? Jeff.
Same idea, although I don't have a pithy example for you. But at the end of B6, we also introduced the important part of that we put in a definition of components, which I think is an important aspect of the standard, but we don't describe why we settled on the definition of components that we did. And so I think similarly here, giving description to the extent we can, like why did we agree with the definition of components, unless we think that, it's self-evident what a component is for these purposes.
Chris.
So I totally agreed with Jeff on 5, but I think that it is kind of understood, and we did such a good job on the definitions and all the stuff that we've worked on in the past. It just seems like it might be messy putting all of that in there. And 2, I don't know, Jeff, if the juice is worth the squeeze. You use one of mine, I use one of yours. How about that? And so I get the point, but I think it's clear enough here along with what's in the actual standard to be okay.
I think I'm with Chris here too, that I liked the last one, and this one I just went back and looked at it, and we even have an example after the description, and the description, I don't know, seems kind of logical. So there's just not as much, I don't know, easily misunderstood, like why did they do that when those things sound the same, or this doesn't make sense, or there was another alternative that would make more sense, or whatever. This one seems more straightforward within the standard and doesn't have the need.
Jeff, did you kind of have 2 things there? Kind of one is to describe what the definition component is, and the second is potentially why the change was made, which I think could just be a short, because we talk about the respondents, the PV brought up issues, and we just said the board put a definition to, and maybe just something very short to assist stakeholders to understand what was meant by the use of the term.
I'm not sure if I'm following that because, yeah, so you're saying this is in a paragraph that's obviously talking about the term components, right? And we didn't have a definition. Now we do. You're saying something else could be added?
I'm saying, say why the board added it. We just said the board added it. I guess that's when you initially said your comment. I thought that's where you were going.
Yeah, I mean, I guess I'm not necessarily opposed to that. I guess what I was thinking of is sort of in the same thing. I was like, well, why did we propose what we proposed? Which is sort of, well, what's contained in the definition. I guess I can't argue with others to say, okay, as long as they feel it's straightforward enough, what we propose, that we don't have to go into an explanation of what we proposed. I'm not sure that there's much else because I think the last sentence, as a result, so I think we're talking about the sentence prior. It's talking about the usage of components, and as a result, we decided because of that usage, we needed to have a definition of components, right? So I'm not sure there's anything else that needs to go there.
Jackie?
I'm fine with the wording the way it is because I kind of agree. This one explains what led us to do it. We had people that were very concerned about it. We came up with a definition. The definition's there, which is different than 5, where we're just talking about ancillary and integral. And I think that 6 is okay. I'm fine with it the way it is.
Thanks, Jackie. Robert?
I agree with Jackie. I'm fine with the way it is.
Thanks, Robert. Diane?
I'm fine with the existing language.
Thanks, Diane. Caroline?
Oh, I'm also fine with the existing language.
Excellent. Sounds like B6 will stay as it is. Anybody have anything else on B6? Not related to that? All right, Scott?
Okay, B7.
B7. Don't see anybody jumping in with comments, Scott.
Okay. We'll take the next section since it's 2 paragraphs together, B8 and B9.
Sorry, I was on mute. I asked if anybody had anything. Jeff raised his hand. Go ahead, Jeff.
So the only thing I mentioned to Scott was in B9, which is a paragraph about information related to deferred maintenance. We talk about the 80% depreciation, which to me is not so much about deferred maintenance, but about capital needs. And so I would rather have the paragraph focus about the things that were about deferred maintenance, which was the maintenance and preservation expenses, and then the RSI schedules. So those were the 2 things that we said in the PV were put in to address deferred maintenance, and 80% was not one of those things.
Jeff, I guess for me, the 80% was part of deferred maintenance, the CapEx part of deferred maintenance. And so to me, we are addressing part of it. I get that there's an OpEx part of cap maintenance that we have now taken out. But to me, they're both part of deferred maintenance. I get maybe in our original PV, they weren't necessarily both part of deferred maintenance because we were saying we can't do anything with the capital part, but here we're going to try to help you with the operational part. by disclosing the actual maintenance expenses. That's not capital, but that's maintenance. But as I think about deferred maintenance as a overall concept, to me there is a CapEx part, and 80% is at least helpful, especially once you put the weighted average age, because now I have more context and all that fun stuff. I think we've at least helped provide more information related to that part of deferred maintenance. Even though I acknowledge we haven't with the other part.
Yeah, I mean, I still see it differently, right? To me, deferred maintenance, I think to most use is is the government spending the money to get their existing assets to the end of their estimated useful life? That's deferred maintenance. Capital needs are you setting aside enough money or what money will you need in the future to replace those assets when they get to the end of their estimated useful life? And I think what the 80% disclosure does is it deals with the latter, not the former. And so to call those two things both deferred maintenance, I think is to muddy what deferred maintenance means, because deferred maintenance is like, I am deferring maintenance on my existing capital assets so that they won't get to the end of their estimated useful life.
I mean, I seem to recall at least a few users in their comment letters talked about both aspects of it being deferred maintenance. So I don't know. I hear what you're saying. I guess I might argue a little bit back to Jackie's, asset that's held together with wire and duct tape, that there's a CapEx deferral because it's really old and it's about to the end. And I'm kind of deferring that capital expenditure because I'm doing every little bit of thing I can to eke out another year that is also deferred maintenance. I mean, I hate, you're kind of one of the users, so I hate not listening to you on the user part, but I just thought I had heard other users talk about the capital part. In addition, I'm not arguing the operating part isn't part of it too, but.
Yeah, I mean, I understand you can defer your capital expenditures, right? But that doesn't make them deferred maintenance.
That kind of gets back to one of the original things we talked about in this thing is how do you define what deferred maintenance is, right? It means different things to different people. So. Oh, what other board members think? Jackie.
I'm kind of where you are, Joel. I agree it's not the expense, the maintenance expense, but when we were talking about preservation and things like that with the capital assets, the fact that we've got all like 90% of our infrastructure assets fully depreciated kind of indicates to me that there are some issues here with they aren't spending, they aren't maintaining, they aren't preserving, they're not doing what they need to do to make sure that the assets are safe. May not be an expense, but it does tell me something about the quality of the assets they've got and what they should be investing in their assets. So maybe a deferred maintenance isn't the right term, but it definitely talks about the deferral of capital assets or deferral of infrastructure assets and what they're doing with their infrastructure assets.
Thanks, Jackie. Anybody else feel one way or the other about what as a board we were kind of thought we were addressing here, Chris?
Yeah, I agree with you and Jackie. I think the point here was the CapEx and the OpEx, and the point here is really around services that the government is providing, like throughways and transportation and all the other things, water services and sewers, and the related cost that might be deferred in providing those services, whether they are capital costs or operating costs. So I'm on the same page as you, Joel.
Chris. Diane.
I'm okay with the language as it is. I think it's important to have this component of it. just to show a little bit more as far as what the government's maintaining and what they may need to expend in the future.
Thanks, Diane. Carolyn?
I didn't have any issues with the way that the paragraph was written, and I agree with your view on this one, Joe.
Thanks, Carolyn. Robert?
I also agree. I get Jeff's point, that I'm not sure that totally the 80% totally gets to the deferred maintenance. But I also sort of read that this was more background, and we get into the ultimate decision and why the conclusion for where the ED is headed, or appears to be headed, is in later paragraphs. So this basically, I read this mainly as this is what the preliminary views were. So it's a building block sort of thing. And then there's further discussion further in later paragraphs in this section that explain where we're at in terms of what may move forward. So I'm okay with the language as it is.
Thanks, Robert. All right, Jeff, I don't know if any of that helps, but
No, but it is what it is.
all right. Anything else on B9? All right, Scott.
Okay, we'll do the next two paragraphs together, the first two of the 6 paragraphs in the next section, paragraphs B10 and B11.
Any comments on B10 or 11? Don't see any, Scott.
Okay, and then I guess we'll group the rest, B12 through B15.
Anything through B15? Jackie?
Sorry, I put my hand up at the end on 10 and 11 and you didn't see it, but do we need to address anything here about the fact that we're going to make them, we're thinking about having them do the retroactive piece here? Or do you want that just to go in at the end? But somewhere we need to put that information in.
I agree. I was going to wait till we got through the section to determine whether, yeah, but you're right. It needs to either go here or in the transition.
Right. To explain why we're doing it in particular, and why it's different from what we've got in here.
Thanks, Jackie. Sorry, I missed the hint. I'm going, like, the Word document partly covers the meeting, and so I don't know, I need to adjust my screen setup, but I missed it. I was trying to look forward into componentization to see how we dealt with the transition for componentization. I guess it makes more sense to put it in the transition part to me, but if we want to almost reference that at transition in this section at transition, there's a different determination, see whatever, that maybe that's helpful. I don't know.
I just don't know how people read these parts. If they're thinking all at one time about estimated useful lives and what they're going to have to do, or if they break it apart and think, okay, this just relates to this, and this other part down here, transition, relates to something else. I'm not sure how people read these. So that was my only concern was, is it too far apart from this for them to pick up on it and put it all together or not?
Scott, I don't know if we often reference to other parts of the basis, but if we had a sentence here that said transition provisions for this, include a retroactive component, see paragraph whatever we add at the bottom, or if we feel the need to do that, do we just do it in the
we references, at the end of B9 we have references. that last topic we talked about. So we could do that.
Would that be okay, Jackie? At least then
Yeah, I think
they
that
know
would
to
be
go
fine,
somewhere
at
else
least.
for something else.
Yeah, at least it lets them know that there's more to come on this.
Okay. I'd kind of rather do that. But it's a good point. It's a good observation. Okay. Anything then on B10 all the way through B15? Carolyn.
Hey, Scott, was my feedback more editorial, or I think I had said in something about, let me get to it. On B15, I said it wasn't another reason why no recommendation is made requiring a periodic review of the estimated useful lives and salvage value of all capital assets is because the project is limited to infrastructure. If an update of capital assets other than infrastructure is undertaken, this may be reevaluated at that time. So my question was, wasn't there another reason as to why we didn't go down that road in addition to what is stated in B15?
Yeah, I mean, the intent of the last sentence in B15 was maybe combining ideas, but not with the understanding that the scope is limited to infrastructure assets. The board still believes it's, important to have this provision for just infrastructure assets because of the, costs of infrastructure assets, or lack of a better term, to shorten it, the materiality of infrastructure assets. But we can try to make the wording better.
Because I said it wasn't, to me, it wasn't material, but I did want to bring it up and see if you thought it should be added or if it was already covered. I didn't see it covered, but I can go back and reread the paragraph.
Jeff?
Yeah, I had the same comment Carolyn had. Because this to me reads like we decided not to do it for this particular thing because, or to do it for this particular thing because of there's a, infrastructure assets are big. My reason for doing it is I did not want to crack open capital assets, right? I thought the whole thing of this project was infrastructure assets. We've discussed why we wanted to focus on infrastructure. And I felt if we cracked open something for capital assets, then we have to crack open other things for capital assets. So to me, the answer here isn't that they're big, it's that the scope of this thing is infrastructure assets. That's why we limited it to infrastructure assets. So I'm agreeing with Carol.
Jackie?
I would agree with that too, because we actually had a pretty good discussion on this part, because some of us wanted to actually do an exception and include capital assets on some of these things. So yeah, I would agree. It was just because it wasn't just because of size, it was also a scope limitation. We decided to keep it in the scope.
Robert?
I mean, I'd be okay with doing something along the lines that Carolyn's suggesting. Could you just refer back to B2 where the scope? Yeah, just to simplify it potentially. So I think that explains it well.
That was going to be my suggestion, is if that's the case, should we add it to B2 up front when we talk about the scope and not talk about it in individual items?
That makes some sense to me.
Something like, after we talked about limiting to that, some of the provisions the board talked about or have proposed in this document may also apply to capital assets as well, but the board believes why the board believes it's okay to do it for capital assets or infrastructure assets only, and then just go on and not address it at each individual item.
Do you
This might
think,
be the
Scott, you would put that up front?
In B2, in the scope and applicability.
All the way up top, you would just say, we considered, or we were asked to consider expanding in certain cases out to. Okay.
Yeah, because it's not just here, right? It's 80% to buildings, and there's lots of note disclosures, and there's lots of things that.
Yeah, this is the big one, but yes, they
Right.
brought it. They did bring it up on others. I don't think we have it in the basis on others, but there were several other the provisions.
That seems like a good solution to me. I got Robert's hands raised, but that's just left over. Yeah, Robert. So Diane.
I agree with what Carol and Jeff brought up, and I like Scott's suggestion about where to put it in B2.
Thanks, Diane. And Carolyn.
I also like Scott's suggestion of putting it in B2.
Very good. Thanks, Carolyn. Sounds like Jackie.
I also agree that moving it out of here and putting it into B2, because we did cover it in some other areas, makes good sense. So I like that suggestion.
Very good. Thanks, Jackie. We will proceed like that then, Scott. Thank you. All right. Thanks, Carolyn. Any other comments through B15? All right, Scott, what you want to do next?
Sure, we'll do the next section. I guess it's 4 paragraphs altogether. B16 through B19 on the componentization, and obviously we'll have to add discussion about what we talked about earlier in the meeting today.
Very good. Diane.
In B19, that last sentence, I didn't feel like Appendix C really provided an illustration of components. It was more on the weighted average, and so I would take out that last sentence.
Diane, you say that again? I'm sorry.
Yes, the last sentence in B19, we talk about the board decided to provide an illustration of components in Appendix C, but I don't think Appendix C really shows much about components. I know it shows like the overlay and that, but it doesn't really explain much. It's more an illustration of the weighted average and the calculation. So I would take that last sentence out.
Once we get to the illustration, I think some of the other discussion might come in and might actually even lessen anything about components here. And so I think it's probably a good suggestion. Jackie?
I was going to say the same thing, that I think that it focused more on weighted average. And since we've changed all of this, yeah, they're not components, they're assets. So yeah, it changes a whole bunch of things.
Are you okay taking that out, Scott?
Sure. Yeah.
Very good. Anybody object strongly to taking it out here? Don't see any. Okay. Anybody else through B19? I had a consideration that I provided to Scott. And actually in B17, we use the word substantially different. And I guess I put to the board, if I look at the basis for 102, we kind of describe that the reference to the magnitude of substantial, the board believes denotes a higher degree of denotes a degree of magnitude greater than significant. And so, I mean, at some point, if we use the word substantial enough, we're not going to say that every time in the basis, and we said it in 102, so maybe we're just good. I just kind of wondered, that was one of the considerations we made, was we increased the magnitude here to try to decrease the cost. You know, is it a well enough term that's understood because 102 uses it now that we're good? Just saying we increased the magnitude to substantial and people understand that, or do we need to bring that description of substantial, which is like a sentence or something, in here or not? Jackie.
If 102 is the only place we've used it, I think
54 is the other large place for the special revenue definition. It's the only other, there are a few other places, but those are the two main places.
okay. It probably doesn't hurt to reinforce it a couple more times before people get it.
Scott, are you okay adding something like that in? Is that okay?
That's fine.
Did any board member disagree with adding something like that in? It's not a big description, just bring kind of that language from 102 in here. Okay, Scott, if you'll do that, appreciate it. Anything else on B through B19? All right, what's next section, Scott, you want to do?
Okay, next sections on the modified approach. We'll do the 3 paragraphs together, B20 through B22.
Any board comments through B22? So I had kind of a broader comment about this section that I guess I put it B22, which is why I'm kind of bringing it up now. That's where I wrote the note. It relates to the recognition and measurement section. And I kind of mentioned this to Scott a bit ago. I don't know how the board feels, but to me, there were, what related overall to recognition and measurement, there were other things we considered, like fair value, like replacement costs, like preservation method for everybody, that we debated in the PV, and we have words in the PV that talk about it, but then none of that is here, even though technically we redeliberated all of it based on the PV feedback. And it just feels like to the users who maybe didn't pay attention to the PV but are here, they don't know we've thought about that, or to even the people that are worried about the cost or the changes, like, hey, we considered things that could have been a whole lot worse. And for cost benefit decision, like preservation method, maybe preservation method of accounting for infrastructure modified approach for everyone is actually a better way to account for it. But for cost benefit reasons, we didn't want to make everybody do that. At least kind of those considerations with some of the language, not all of it, but some language from the PV being included here, I thought would be beneficial, but I don't know what the other board members, what you might think. Jackie.
I'm certainly not opposed to that. We did talk about it again, and there were people that thought we should do it, even though in the preliminary view we said why we weren't doing it. It's not going to add a lot to just comment on the fact that it was considered again, and we continued to believe that it's not cost beneficial for them to use other methods. So I don't have a problem with including it here.
Thanks, Jackie. Carolyn?
I agree that it will be helpful to include it, and then provides more insight into the deliberation process.
Thanks, Carolyn. Anybody opposed to including some language here? Doesn't seem like it. Okay, so Scott, we can add something. Is that good enough?
That's good. Do you think it should go here? Do you think it maybe goes at the beginning of the section?
Maybe the beginning of the section. I know I kind of brought it up at the end because I got to the end. I'm like, it isn't in here, but wherever you think it fits best, it doesn't necessarily have to come at the end for sure. The beginning probably makes more sense because then we follow through with these are changes to the existing approach because we didn't change any of the other things.
Okay.
Thank you. Anything else through B22? Diane.
In B21 and B22, we reference the requirements in paragraph 23 of statement 34, but we've now pulled all those requirements into the standards. So it seems to me like instead of referencing 34, we should refer back to paragraph 8.
Scott's nodding his head affirmatively.
Okay.
Sounds like he agrees. That makes sense to me too. I see other board members agreeing. Thanks, Diane. Anything else through B22? All right, Scott, next section.
Okay. We'll just, the next two paragraphs, B23 and B24, the first requirement under notes is divide by network.
Scott, I know I mentioned this to you, and it comes up here. This may not be the only place, but it certainly as it relates to the notes to the financial statements, we did do a field test that helped inform our decisions related to the notes. And it seems like we should kind of sprinkle that in, I guess, throughout or discuss the field test in some way as contributing to the decisions we made here for the notes. And you've agreed, you're nodding yes, we'll do something like that. But unless my fellow board members for whatever reason object to that, I think the team will try to fit that in where it makes sense in this section. Anything else on B23 or 24? Jeff?
One thing I had talked to Scott about, I'm not sure, and Scott, I think you said you might try to change it, but that last sentence of 24, I wasn't really sure because, for the first time, we're adding disclosure by network. And then we say government should have all this information by network because right now they're disclosing only by infrastructure, right? And so now we're making them disclose it by network. And we're saying they already have it by network. Is that a true statement?
I don't want to answer for you, Scott, but that's actually the sentence that I highlighted and said and brought up the field test because the field test showed that the governments have the information necessary to be able to do it. They don't necessarily have, it's not all done, but they have enough kind of in their background, et cetera, with the detail of their capital assets to be able to do it. And I think that's what we were trying to say. And the field test seemed to support that. Some of them said it took more time than others, but they all had the information to do it. And so that's actually the sentence I highlighted and said, field tests helped us here. So I don't know if Scott has a different reaction or other board members, but that was my reaction to that.
Okay, that's helpful. Thanks.
Anything else on B23 or B24? All right. Scott, what's our next section?
Okay, paragraphs on the monitoring policy, 25 through 27.
Board comments on B25 through B27. Jackie.
I think that what we've done in the standard itself will take care of this, but I was concerned about the last sentence because it didn't align with paragraph 10 in the exposure draft, but thinking the wording probably now better aligns with what we changed in paragraph 10. So it probably doesn't need to be looked at again, but just in case we want to make sure that it aligns with that.
We did the last sentence of B25, Jackie, is that what you said? Yeah. That probably should change to, instead of providing a summary, would be brief description or whatever the words are that we've adjusted the top to, but yeah. Anything else B25 through B27? All right, Scott.
Okay, the next section goes several pages, so maybe we'll just take a paragraph at a time, or at least start with the one paragraph here, B28.
Comments on B28? All right, nothing on that one, Scott.
Okay, I guess we'll do the next page. We'll do the first two the two paragraphs that come on are fully on that page 13, B29 and B30.
Comments on B29 or 30? Jackie.
Again, I think in B29, where we're talking about separating the historical cost of infrastructure assets by network of infrastructure assets, I think now that we've made some changes earlier in the standard, this one isn't as much of a problem with me as identifying what it is they're supposed to actually be keeping track of with that 80% thing. So I think now the wording aligns better with all those changes we made on the historical cost weighted average paragraph. But something that we just want to make sure we check to make sure that the changes there align with what we've got here.
Sounds good. We might need 100% thrown in somewhere in this section. Yeah. Anything else on B29 or B30? All right, Scott, what's next?
Okay. B31.
Any board comments on B31? Jeff.
Yeah, I mentioned this to you. I think, Scott, you said you would fix this on line 37. You say information related to the age of infrastructure assets. I see it more as information about the amount of infrastructure assets that are nearing the end of the useful life, or the prevalence of infrastructure assets that are nearing. And the age is just one aspect. It's not really age. I'm really thinking of magnitude, right? Of what those amounts are is really, I think, the message that is being sent to users.
Jeff, I sent to Scott an edit to put just amount and age of. I just add the words amount and in there, and it kind of did what I had a similar reaction, and that was how I fixed it.
Yeah, something to that effect. Yeah, I think that would be helpful.
Anybody else? B30 through B31? All right, next section, Scott.
Okay. Description of the modified approach, B32 through B34.
Anything on this section, B through B34? Comments there, Scott?
Okay. And then the last part of this, talking about not bringing in maintenance preservation expenses that was referred to earlier, B35 through B37.
Any comments on B35 through 7? No comments on that section left.
Okay, moving to the RSI. We'll take it all together, I guess, B38 through B41.
Comments on this RSI section? Jackie.
In paragraph 40, the last sentence, the last clause in the last sentence where it says, The board believes that governments should disclose in notes to RSI that such changes were made, as those changes likely affect blah, blah, blah. To me, it seemed like we could clarify what we meant by what that such changes were. So I had suggested maybe some clarifying language that notes to RSI any changes in condition level that were made, rather than that just such changes. Because what we're really talking about was condition level there. So just clarifying language was what I had recommended.
Diane?
I had a comment on the same sentence. My recommended change was take out the as and put and the reason. Those changes likely affect trends in the information reported. So I don't know if that gets at Jackie's same issue, but I think there needs something in that sentence.
Jeff?
I had the same sentence, so we got the trifecta here. I think, Diane, I agree with you but I think we have two separate thoughts. One is that if you change your condition level, you should disclose that because that could affect your trend. But then I think we also decided that if you change your condition level, you need to give the reason for the change. And that reason for the change may not, I don't know that that's trend. It's just the condition level change affects the trend. We want the reason for the condition level change. I see Scott nodding his head. So somehow to make those two separate thoughts, I think there is the objective.
Sounds good. We'll leave that to Scott to clear up a little bit. Anything else through B41? All right. Next
Okay.
section.
Yeah, next section's one paragraph, B42.
Anything on B42? I guess we're good there, Scott.
Okay. Let's just take, since there's 5 paragraphs, let's split this 3 and 2. Let's do the first 3 on considerations related benefits and costs, 43 through 45.
Comments on 43 through 45? No comments there, Scott.
Okay, and then the last 2 paragraphs, the last one on 17, the first one on 18, 46, and 47.
Any comments B46 or 47? Don't see any.
Okay. Then obviously there'll be a lot of changes in 48 through 52 based on the board's previous discussion today. I will still go through them. Is there anything that the board wants to talk about in addition to what will be added? I guess we'll just do all of them together, 48 through 52.
Sounds good. Anything on this section through B52? Understanding we're gonna have some edits based on what we did before, but anything specific you want to be sure to bring up that may not be encompassed in that? I don't see any other comments on that section, Scott.
Okay. Moving on to the next illustration, Appendix C. Hearing what we talked about earlier today. Probably in the assumptions page that lists has the first column and components. We'll probably break that table into 2, one for road network assets and one for bridge network assets is what that'll say instead of components. And then obviously the calculation charts on the next page based on the formula we talked about earlier. The formula will change and we'll add the wording in the disclosure of, and accumulated depreciation to cover the 100%. Are there any other comments that the board has based on what was presented on those 2 pages?
Robert?
Yeah, maybe I'm just dense these days, but the formula that's shown in the weighted average age column, I'm not sure how that's computing.
As we talked about earlier, total of column A. So it'd be A times B divided by total of A.
So for that section, Robert, I gave Scott, there's already I think it's called an exercise in one of the non-authoritative like illustrations or all the stuff we had for statement 34 on a weighted average age calculation.
Okay.
And I would suggest we actually show it like that, where it kind of took asset, it showed its maybe estimated useful life, I don't even know, it showed its age, and then it showed the cost, and then it had the column that multiplied out. It showed the product of age times cost, and then it had totals, and then those totals were divided by each other to get the rate. And maybe a presentation where you kind of just see the calculation like that would work better than what we've done here. The formula, you gotta maybe figure out if it's needed or how it's shown, but
I think that would be helpful.
And where is that shown, Joel? Or where's an example of that? You have it? You don't have to.
It's exercise 9 in the comprehensive implementation guide in appendix B73.
Appendix
there you go.
B73, you said, Scott?
Yes. It's also in the illustrations at the end of section 1400 of the codification in the non-authoritative section. And that example, at least the exercise in the SIG, has more in it than what we need, because it actually shows one to do it by cost and one to do it the weighted average calculation a different way. So we don't need all the parts of it, but because we've told you it was cost related, I think that the presentation of the cost columns in that exercise is what I would think might be better here. And so Scott, though, changed the topic there. Well, does anybody else want to talk about the formula or the calculation, or have other ideas for presenting kind of that part of what's going on here? Jackie?
Nothing other than the fact that it really did need a lot of work and needed to be clear on what was going on. So yes, I think that the suggestions you're making are probably good ones. It'll make it a lot easier for people to understand.
Thanks, Jackie. And so Scott, when you said you were going to maybe the table that's in the assumption column, or this right under the assumptions on the first page of the illustration, you said you were going to break into 2, like road network, and at the top of that column we say component. Are you going to take? We're not going to call it component at all. We're not going to use
that's what I said. The component for the first one will be road network assets.
That's what it'll say. Okay, I kind of thought that was what you said, but I wanted to clarify. Okay.
And that filters down into the subsequent tables, right? As you break it out, we don't call them components there. You're gonna break it out road or bridge.
Yep.
Scott, the other comment I had in the actual example disclosure, I think we need to there's a difference between the 80% and 100% being based on your estimated useful life or based on how depreciated the asset is. And the standard says estimated useful life. And I think that's the better result. That's the better thing to use. But the disclosure kind of seems to talk about 80%, but we're not yet fully depreciated. I wonder if instead of kind of trying to mix that up, if we say it's 80%, but not yet reached the end of its estimated useful life, or try to use estimated useful life anywhere in there we can instead of,
Yeah,
how depreciated it is.
we'll mirror the language that was
Okay.
changed earlier to, but not yet exceeded 100, whatever the wording we talked about.
Okay. Jeff.
I just have one last question on the disclosure itself. We say at the beginning, because we know how much stock, I guess I've learned a lot about how much stock governments put into the illustrations, right? In the disclosure, in the sample disclosure, we say of the government's transportation infrastructure assets. There could be governments, right, who think transportation is the network, right? And so would we be suggesting that transportation is not a network, roads and bridges are networks? And we don't want to make that suggestion because a government may want to just combine roads and bridges and call it their transportation network. So it might just be as easy as stripping out transportation and say of the government's infrastructure assets, roads with a historical cost. And, this is an example of one that does roads and bridges, but you don't have to do it necessarily that way.
I agree with you, Jeff. I didn't note that. I didn't catch that, but yeah, I would just delete transportation. And I think because I would agree. That's good. Anybody object to that? Scott, you object to that? All right, thanks, Jeff. Diane.
So on the table where we list all what we're calling components there, I think we ought to throw in just like some like road XYZ and just some other things. We put a real emphasis on the component piece when this was developed with all the road bed, road overlay, and so on. But I think we ought to make it clear that there's other infrastructure assets that maybe haven't been split out. So like road XYZ and would be another infrastructure asset.
So in other words, have some of the roads not have overlays on them because they haven't yet replaced it. So they're still in this part.
Generally, in the past, we have not illustrated items that were not accounted for in the manner that the current standard is talking about. I understand why you're doing that because of the long transition period and things of that here. But generally, when we provide illustrations in the past, it's with the, the government having done things as the standard is requiring them to do it. But we could, if the board wants to.
Diane, does it help that bridge network is going to be its own thing and you're going to have individual bridges and none of the bridges have components? Does that kind of do the same thing you're trying to do?
It does, but do people look at this and go, oh, well, wait, I don't have all my roads broken out that way. And even though we're telling them they don't have to do that yet. And it just seems to me like throwing it in so that they understand that, hey, yeah, there's some that you haven't broken into components yet. And, and maybe it's just do another type of infrastructure too, having to do with the water plant or something like that.
The bridges don't do that though already.
Well, yeah, it does kind of. I mean, that was my whole problem with this to begin with, that I didn't consider bridges components, but it just we're making a big deal about road bed and road overlay and as components, and most of them aren't going to have all of that broken down when they first do this.
Chris?
I just want to make sure I understand what Diane's asking. So in that first schedule there on, oh shoot, on page 20, you're basically saying just put road in there as well, because that's the whole everything, and then also have it included, and then the component and like the 80% or, you know, of and then included in there as well. So you have road beds, road overlays, and roads, so that you could see that they're different pieces. Is that
Yeah,
what-
and the road overlay and road bed would not be part of the one that's just road.
Right.
To indicate that, hey, you still have some infrastructure assets out there that are like just the full road. And so that could be road XYZ, but then you have road bed one and road overlay one, and you know that they're not integrated. They're just showing that there can be different types of road type of asset, infrastructure assets, with or without the components.
Gotcha.
I guess, Diana, if we'd ended up where it was going to be a long time and you were going to always have these roads and they would never be, never have a surface because we just kept the old accounting for those because of the transition, I might understand, because we could have 50 years or something of people having this. Because of the way we changed it, this is 7-8 years, everybody's going to have replaced the road surface. There aren't going to be that many roads that are just roads at that point, because all the surfaces are going to be replaced at least within the next 10 years, I would expect, most of them. So it becomes a shorter time, of which we're now, to Scott's point, we're exhibiting guidance that is almost transition reflective, and wouldn't 10 years from now might be kind of obsolete in a way, or almost misleading the other way. I mean, your point's still there. It's just it's not going to be there for as long because of the earlier discussion. But
Well, is it true that everyone does it? Well, I guess it does. Because I thought we talked about before how some governments and their maintenance, they might just, replace the overlay everywhere, where some dig deeper into the roads and really replace the roads. So in 10 years, you can still have some that won't have the components of overlay or et cetera, and they'll just have road because that's the way they choose to replace, or no, not in practice.
I mean, you would have to determine that the road surface that you replaced or whatever is not substantially different or significant enough for you to be able to make that determination ultimately, I guess. Because when you replace the surface, if it meets that requirement, the transition guidance kind of forced you to do it. So if anybody else is kind of with Diane, I don't want to move on from Diane's point too much, but Jackie.
I'm kind of okay with what we've got, because I do think bridges help address Diane's point. They don't have separate components. It's a bridge, a bridge, a bridge, and we haven't broken them out into spans or anything like that. So we've got the whole bridge. So I think that helps to some extent for them to be able to see that it doesn't necessarily have to be pieces. It can be a whole thing.
I would agree. If we didn't have any of them like that, then I would agree. Okay. Anybody else? Anything else on the illustration? Example disclosure. All right. Don't know how many comments we're going to have on the codification instruction. I'm trying to decide whether we take a break now or we just finish infrastructure and take a break.
Finish infrastructure.
Finish infrastructure. Okay. All right, Scott, how do you want to do the codification instructions? As a whole?
Can, or, I mean, there are only 2 sections, so. Obviously, anything we talked about today will have to be added in.
it's just, if anybody has any comments on the codification instructions, I would say I mean, I had some where, you know, I would say more editorial, making sure they line up. And there are a few places where, you know, small change that was made in the standard didn't make it to the codification instructions. I highlighted a few of those for Scott and the team. I think we have to address those. I will say that there were, and I just gave them to them yesterday. And so they haven't had time, but I had a few additional implementation guide questions that I at least wanted them to look at to see if maybe they should be modified or even maybe just rescinded because of these changes. But so I would just say in the next version, you may see some things, some additional Q&As that weren't addressed here that might be addressed in the future one, but I don't know that we need to go through each of those. I'd rather give the team a little time to do their analysis of what they think before trying to hash that out here as a board. But I also didn't want to not kind of totally bring it up. But I get that's essentially my COD instructions kind of are summarized in that. But if anybody, you know, others have anything they want to highlight or comment on in the codification instructions? Jeff.
Yeah, and this might be one of the ones, I agree with you, Joel. I also had a few sort of consistency things, which I assume will be taken care of. And there was one codification question. It may have been among the ones, it was included in the COD instructions. It was not edited. It was the one that was, I guess it was the level B guidance that's being elevated to level A. And it's 7.14.14.4. And I spoke to Scott about it because the way I read it, it says periodic assessment may be appropriate. And I don't think that's consistent with what we just put in the standard, right? I think that thing will need to be edited to make it consistent with the standard to say, you know, you need to do this. It's not an optional type of thing.
Or at least consider adjusting it for infrastructure or non-infrastructure or something, right?
Right.
Because we wouldn't want to change the guidance that exists for other capital assets. And if it says may, then that's what we'll stay. But
that's true. Or either that or cite to our whatever we do to make it clear that it's not optional on this guidance.
Right. Yeah. Okay.
I mean, I think we take those, look at those, and I think if we determine there's any we got to change that aren't in this document, we'll make sure to highlight those when we bring the next version back, so you know exactly what we've changed. So yeah. I think that's probably the better way of doing it rather than doing it on the fly here at the table. That one included, Jeff.
Yeah. Anything else anybody has? All right, Scott, go back to the front.
Yep. So I guess we'll start with the front matter. Board's expected to approve this at the March meeting. I believe the current publication schedule would be, if that occurs, it would be posted on April 9th. And probably approved somewhere, I think, between the 23rd and the 25th, I think, are the dates. So we were looking at, you know, probably the end of June being the, you know, a 90-day comment period.
So I know I expect then that by the ballot draft, we'll probably have the public forums nailed down. Al, yes?
Yes. Well, yes, we know numbers. Essentially, we're going to work on the dates to make sure the dates make sense. But yes, you'll have to have that ballot draft.
Okay. Yeah, I would just, I think that as you're thinking about that, we will have to think about, there's a GASAC meeting, and if we want a live public forum to associate with the GASAC meeting, that's late June, like June 22nd or 3rd or something like that. And so we'll just have to play with all of that as it relates to timing, et cetera, et cetera. But
I mean, that's a perfect example of what we were talking about earlier this morning with Scott is theoretically that meeting is going to happen before the comment period of this document is over. And is that
Alright.
okay or not okay? And so we got to think through some of those things to figure out what timing makes sense. But it would, so again, it would be in the ballot.
Okay. We'll leave it with you guys to figure out as best you can and look at it, the ballot. Any then other comments on page, I don't know if Scott called page 1 and 2, but that whole front notice kind of section. All right, Scott, do page 3, the notice to recipients. I don't know if that was included before, but pretty standard language there anyway. Anybody have anything on that page? All right, Scott, I don't step on your toes and jump on your job.
No, that's fine. We'll move on to the summary then, and obviously we'll carry forward changes that were made as a result of our discussion today, and we do have your editorial comments.
Anybody have anything they want to bring up and discuss as part of the summary discussion? All right, it doesn't look like we have any comments there, Scott.
Okay, well, I think
Table of contents,
we
I
didn't
guess.
do the table of contents. We'll amend that too for any changes, because I know we'll have paragraph changes based on discussion today.
Excellent. All right.
So we just need y'all to approve our ability to bring you a ballot draft.
Let's go for it.
Jeff.
I guess I disagree.
Yes.
Is that what I'm doing? I'm disagreeing here, right?
Yes, you are. That is true. Chris.
So do I approve? Is that the
Yes, sir. You do. This is approved, not consent. You're approving, sir. Caught me off guard there, Jeff, but you were right. Carolyn.
I approve.
Yes, ma'am. Diane.
I do not approve,
That's
right?
right. That's right as well. Good job. Jackie.
I approve.
Yes,
based on what Diane
ma'am.
said.
Yes, ma'am. Robert.
I approve.
Mr. Chair.
I approve.
Excellent job on that, folks. I appreciate that. That was a little harder. We appreciate that. We will move forward to bring you a ballot draft at the March meeting.
Thanks, everybody. Really appreciate it. Important project. Appreciate the good discussion and moving this forward. Scott and team, thanks for pulling all that together. We look forward to the ballot draft and the changes.
Hey, thank you.
All right, we will see you next time. With that, let us take a break. And for mountain time people, this is kind of lunchtime, so like 20 minutes.
15?
More or less. That's good.
15's good.
15's good. Okay, let's come back at 3:10 Eastern time then. See everybody then. All right, welcome back. Hope everybody had a good break or lunch or whatever it was you needed to do or had time to do, given whatever time zone you happen to be in. Well, we were moving on, and I didn't preview what the next topic was, but we finished our infrastructure and we were moving on to our going concern uncertainties / severe financial stress / probable dissolution project. And Deborah and team are here. Deborah, I will turn it over to you to kick off what we have to discuss for this board meeting.
Great, thank you. Good afternoon, everyone. We do have one paper to discuss today, and it is on the topic and of the phrase and concept of going concern. So one of the issues that this project is seeking to address is how should the existing guidance on going concern uncertainties, including the definition of a going concern, which doesn't currently exist, but how should that guidance be clarified or improved to reduce diversity in practice in applying the guidance? And so that existing guidance is found in our statement 56. and was adopted essentially as is from the AICPA's auditing standards. It uses the term going concern, but does not provide a definition. Many other standard setters, both accounting and auditing, use the term going concern and have standards related to it. Although often it is not clearly defined, or when it is defined, the definitions are not the same amongst those different standard setters. The exception is FASAB, the Federal Accounting Standards Advisory Board, which decided that going concern does not apply to the federal government and did not incorporate the old AICPA guidance into its financial reporting guidance. The AICPA auditing standards require auditors to audit disclosures related to going concern, as well as make their own evaluation as to an entity's ability to continue as a going concern. However, those standards also do not define what it means to continue as a going concern. So during the deliberations leading to the preliminary views, we used the term going concern to describe ideas related to the continued legal existence of a government. Stakeholder feedback received during those deliberations did not yield any significant disagreement with using going concern in that manner. However, the board later decided to use the term probable dissolution instead to describe those proposals, and the going concern phrase was not used in the preliminary views under the belief that the severe financial stress and probable dissolution terminology was more descriptive of what we were trying to accomplish. Feedback to the preliminary views found that some stakeholders supported the proposal not to use the term, citing the greater clarity from severe financial stress and probable dissolution. Other stakeholders disagreed, and there were two primary reasons for disagreeing. One was divergence from other accounting standard setters, and the second was the relationship with the auditing standards. So that feedback indicated not only disagreement with eliminating the term going concern, but also disagreement with defining it solely based on legal existence. In other words, those stakeholders would not agree with simply swapping the probable dissolution terminology back to going concern. Some stakeholders believe the term going concern to be well established and well understood. Although it may be well established given the use across different sectors of the accounting industry and the history of the use of the term, whether it is well understood may be questionable. And to give us more information in that regard, we conducted a survey, and Eniola is going to tell us a little more about the results of that survey.
Thank you, Deborah. We conducted a survey to understand how different stakeholders interpret the phrase continue as a going concern in existing guidance and whether that interpretation differs by stakeholder type and background. The survey did not ask whether stakeholders believe the phrase should be used going forward or how it should be defined. The survey was sent to all preparers, auditors, and users in the GASB stakeholder database, and we received 649 responses. Stakeholders were given 5 choices for which interpretation best describes the phrase. The choices were 1. A government will continue to exist as a legal entity. 2. A government will continue to meet its obligations as they come due. 3. A government will either continue to exist as a legal entity or continue to meet its obligations as they come due. 4. A government will both continue to exist as a legal entity and continue to meet its obligations as they come due. And 5, that they are unsure. Auditors answered 2 versions of this question, one for Statement 56 and one for the audit standard AUC 570. For the AUC 570 question, the first option was modified to a government will continue operations reflecting the language within that standard. Across all groups, about 50 to 60% of participants interpreted the phrase to mean both continued existence and meeting obligations. The remaining responses were more dispersed, and the distribution varied by stakeholder type. Follow-up analysis examined whether experience influenced interpretations. Preparers with private sector experience were statistically more likely to interpret the phrase as meeting obligations, aligning with the FASB use of going concern. Similarly, auditors who spent more of their time auditing entities against FASB standards were more likely to apply the FASB interpretation when evaluating going concern under GASB standards. Users also showed variation by type, though most interpreted the phrase as both continued existence and meeting obligations. Finally, 245 participants provided open-ended comments. While some believe the term is understood, many more express confusion and a need for clarification. Several comments highlighted concern about inconsistent definitions across standard setters. I'll now turn it back to Deborah.
Thank you, Aniola. So there is debate from an accounting theory perspective on whether a going concern assumption is necessary for financial reporting. However, regardless of the theory, preparers only have to consider the assumption if the accounting standards require it of them. Now, some standard setters require financial statements to be prepared on a going concern basis of accounting, except in certain circumstances, and preparers must make that determination of whether that basis is appropriate. GASB guidance does not require that. Some standard setters also require certain note disclosures if there is uncertainty about an entity's ability to continue as a going concern. GASB guidance does require that, although that is the Statement 56 guidance that was just carried in from the audit standards. There are two reasons why the term going concern should continue to be used in GASB guidance. The first is that it provides an opportunity to clearly define the term as it relates to state and local governments. As seen in the survey results in particular, stakeholders do not have a common understanding of the term as it exists today, and we could provide clarity in that regard. The second reason to retain the term is to facilitate application of the audit standards. So the audit standards require the auditors to evaluate an entity's ability to continue as a going concern. And currently, the accounting standards require preparers to make that same evaluation. And auditors are concerned about having the sole responsibility to make that evaluation if the GASB standards no longer require it of preparers. However, there are also two reasons why the term going concern should not continue to be used in GASB guidance. And the first reason is that it is not necessary to provide essential information to users. So because the GASB does not have an alternative basis of accounting, the only potential impact on financial statements is disclosures. And because the details about either severe financial stress or probable dissolution would be required by the other parts of this project, the only potential disclosure, additional disclosure, that would come from requiring preparers to evaluate going concern is simply a statement that there is uncertainty about a government's ability to continue as a going concern. The project staff does not believe that this sentence provides incremental information to financial statement users and potentially causes greater confusion because of the preconceived ideas that people have of what that phrase means. The second reason not to require evaluation of the going concern is the confusion that exists around the term. Even if we were to provide a clear definition in our standard, there would need to be significant education efforts in order to ensure that stakeholders understand the meaning of the term in our standard might be different from what they have previously understood the term to mean and different from how other standard setters use the term. So the project staff believes that if the term going concern continues to be used in the GASB guidance, it would need to be clearly defined, given the research results and other feedback that indicates there is a need for a consistent understanding of the term. However, the project staff cautions that defining the same term differently from how it's used by other standard setters might cause more confusion than using a different term altogether. The project staff also believes that the requirements of accounting standards should be based on the needs of financial statement users. That's in line with the objectives of financial reporting in Concept Statement 1. And feedback from users indicated that they generally do not need the term going concern. The stakeholders that are most interested in retaining the term going concern are auditors, and that is because of the relationship with the audit standards. And those audit standards assume that the accounting standards are going to require this evaluation. However, the project staff does not believe that the assumptions of an audit standard setter as to what is in the accounting standards should be the primary reason for deciding what is in the accounting standards. The project staff believes that the needs of financial statement users would be met through the disclosure requirements being pursued through the other parts of this project, the SFS and PD disclosures. The project staff also believes that requiring preparers to evaluate a government's ability to continue as a going concern is not necessary for financial reporting, and that the lack of clarity around the term as it exists today would require more of an education effort than a brand new term. Therefore, the project staff recommends that governments not be required to evaluate whether they will continue as a going concern, and thereby eliminating the term from the authoritative guidance. And so that brings us to board question number 1. Should governments be required to make an evaluation, which is in addition to the evaluations of poor financial condition and uncertainty about continued existence that are already being pursued in this project, of whether they will continue as a going concern, eliminating the term going concern from authoritative GASB guidance? And the staff recommendation is that government should not be required to make that evaluation.
Thanks, Deborah and team. I appreciate that. I also appreciate all the efforts that you've gone through. I think the survey was very interesting. I appreciate all the effort that went into that. I think it was informative and helpful. I know that the paper talks about this, and I personally know that you've had, a couple at least, or numerous discussions with auditors, including AICPAs and groups within the AICPA. So I appreciate all the continued dialogue and efforts you've made to engage with our stakeholders about their feedback, even beyond the public forums and all of that. So I know a lot of work has gone into that, and I really appreciate all of that, and you bringing that all into this paper. So I think I'm going to start here. I kind of have a lot of thoughts, and I've kind of written them down, and I've tried to organize them so that I don't ramble too much, but I will probably talk a little bit too long, and I apologize for that. I've thought a lot about this. I've been in some of the conversations with auditors. I haven't been in all of them. I've heard about them some, and in the end, the kind of bottom line is I would like to keep the term going concern in the literature, and I'll try to articulate kind of how I get there, but I certainly understand the staff's recommendation and the reasons for it, and they're certainly valid reasons in there. When we're leading up to the PV, and we at the kind of last minute changed the terms from going concern about continued existence to probable dissolution. There were a few of us that were worried about that then. I think that even those of us that were worried about eliminating the term then were like, well, at least we'll get feedback. Like, it will be obvious. And we got feedback. Like I think it was certainly the right kind of call at the time. We've heard from people, so we've proposed this change, and we have feedback to kind of deal with. Even with that, the feedback is mixed, right? There are, as Deborah pointed out, there are people that agree, yeah, that, going concern kind of doesn't mean anything to governments, and these two things you have are important, and this is good information, this is kind of all we need. We have others that don't agree with that, even within the audit profession. I think you saw some of that split, although certainly probably more auditors or on the side of we need to have interoperability with our standards, and that is important, and therefore you shouldn't get rid of the term. But even some auditors were like, yeah, this makes sense and keeps governments different. So I kind of acknowledge all of that. I was I'll say, I've kind of evolved in my thinking and learned a lot through the discussions. I was very much in the camp that the continued existence was the important part of going concern. And so our previous, decisions to have it be about continued existence made all the sense in the world to me. I think based on everything I've heard and learned and the survey and everything, I've stepped back from that. I'm like, okay, I give up. They're both aspects of going concern, the continued existence and the ability to pay are an important aspect of how people interpret them. At least a vast majority of people interpret pieces of those, if not both of those, to be involved, although the amounts and sometimes even which one it is always consistent, right? I think this is an important point, and I think I differ with the team on this a little bit, that this is probably the auditor in me, right? That the users rely on the ultimate report in two ways. They rely on the financial statements and they rely on the audit report to tell them that the financial statements are materially correct. And in doing that as an auditor, I have to be independent of those financial statements. I can't prepare them on my own. Yes, management has some bias about what they report or would have some bias about a going concern assumption or assertion, but they need to make it and the auditor needs to audit it in order for the audit to have value as an independent, objective evaluation of what's going on. And I think to leave that assertion about going concern, which in particular, I think is about the ability to pay your obligations within 12 months, is what it seems like the auditors, a majority of them, kind of hold their hat on. That's what they want asserted. If there was one thing that in particular they didn't like about our proposal, the biggest thing they didn't like, it was that management no longer had to make an assumption about, is it probable that I will be able to pay my obligations when they're coming due 12 months from now? And I hear them on that. In their auditing standards, if management doesn't make that assertion, they still have to do it on their own, but now they're doing it on their own without management having to assert that. And I kind of agree with them. I would like for management to have to assert that. Now, could we build that into SFS somehow? We can get to that when we get to SFS and maybe question 2 a little bit, or even a future paper where we talk about SFS. There's paths forward to dealing with that and not having it to be about going concern. But in the end, I think that's an important point. And so it's part of what's leading me to want going concern to stay. I think that even though we don't have this other basis of accounting alternative, as Deborah points out, there's a sentence in 56 that talks about the continuation of a legally separate governmental entity as a going concern is assumed in financial reporting in absence of significant information to the contrary. I think that's kind of fundamental for our accounting, that accrual accounting, the accrual basis of accounting is built on the fact that we will continue to exist. And so does the probable dissolution disclosure gives you continued existence information? It does, right? But I just think this kind of notion of going concern encompassing both or aspects of both of them as something that is really elevated in importance in users' minds, hence the auditors wanting to specifically address it in their audit report, I think says this one's a little different, right? And that this assumption, this whatever you think going concern is important to users. And I just worry about, I get that we're going to have to describe it the understanding, there is no universal understanding of going concern that's exactly correct or exactly the same as the other standard setters. But I just worry about going too far astray if we just eliminated it and left it only with the auditors to do. And so I kind of have an idea. I will say, I think the existing disclosures that we have created with probable dissolution and SFS are important, valuable. I don't really want to mess with them a lot. We'll debate them in the future in future papers and maybe figure out ways to improve them or tweak them or whatever it is. But I think there's a way to layer a going concern terminology that builds on and uses probable dissolution and SFS without messing with them too much, but keeping this kind of notion of going concern as being some subset of them that's a higher level of concern in a way, depending upon how you ended up in probable dissolution or SFS. And so I'm almost done. I agree that essentially we're adding complexity to the standard that you could argue isn't necessary, because probable dissolution and SFS, those disclosures give the information to the users. I agree with that. I agree that primary reason probably that we're adding that complexity in is really to enhance the interoperability with the auditing standards. But I just feel like that's probably important enough, and I don't want to say easy enough for us to do, but I think there's a path to doing it that isn't overly complicated or doesn't mess those other two things up. And I would, I guess, vote or lean for us to try to do that moving forward in the project, and thus would kind of hope to keep going concern as a term using something within probable dissolution and SFS to describe it. Diane.
So I believe that the term going concern will need to be defined in this project. I think we can define it in a way that that makes sense for governments. I went back and read SAS 132 to get an understanding more from the audit side from what they're requiring. And I think that we can come up with a definition that makes sense for governments. I think it's important to use those words, going concern, due to the prevalence of the term in financial reporting in the private sector, the use by other standard setters, even though their definitions are not all the same, and the audit requirements to assess going concern. And when we brought this to the GASAC, it was so divided. Nobody was really, there was no consensus coming out of there that it should be one way or another. But I really think that we can develop a definition that will be integrated with what we've done on SFS and PD. And I think that's really important. I don't want to create a lot more structure, but I'd like it to be integrated and we come out with a definition to going concern.
Thanks, Diane. Jeff.
So my response to staff, I guess I phrase it as I tentatively agreed with the recommendation in part. And in part, I believe, I think I was one of those who had a little struggle with losing the term going concern. And I think we can consider a path of bringing it back, like Joel's talking about. I sort of think about it in my own mind as what I call an umbrella term. And it sits on top of SFS and probable dissolution. And in that way, I'm hoping to avoid the fate of what Diane is talking about, of having to create a whole cloth new definition of going concern, which I don't believe is necessary, because I think we've done a lot of good work with SFS and PD, which to me are the comprehensive notion of going concern, right? So it sits there as an umbrella term. I don't see it as the paper sort of portrayed it as an additional evaluation that the governments do. I see the evaluation that the governments do as an evaluation of PD and SFS, which they were doing already. They're just doing it under the umbrella term of going concern. And I thought about that for the consistency in our literature. I get the point that there's confusion if we define it differently, but as we've seen, not including it led to confusion. So to me, it's like pick your confusion, right? Like this is a difficult term to get. And so I feel like, okay, we can go down the PDSFS path. I think, as the paper also points out in the way I'm thinking about it, there's no loss of information to users, right? The information to users is going to come about via those PD and SFS disclosures that we have that are really unchanged by the way I'm thinking about it. And then I'm sort of looking at Joel here as an auditor, right? And saying, okay, I heard those auditors' complaints, right? I'm trying to be sensitive to it and sort of create a solution that, helps the application of the auditing standards. And I think I get there. We may have to do some more work when we get to SFS and PD, but I'm trying to do that because in my world, then the government is evaluating going concern. They're doing it through these mechanisms of PD and SFS. And so that they're going first, right? The auditor isn't having to go first. So I think I agree with the idea that going concern as a term should live on.
Thanks, Jeff. Jackie.
So I agreed with the staff recommendation. I don't have the same feeling about going concern as the others. I believe that the information that we're providing as PD and SFS is far more valuable than the term going concern is. I would be open to looking at what Jeff has said about an umbrella term, but having the governments have to go out and do yet another evaluation to come up with going concern isn't working for me. And if we put severe financial stress and PD under the umbrella of going concern, we have to realize that severe financial stress doesn't really have anything to do with going concern. Most of the governments are going to continue regardless of what happens. So the term again is misleading if we do it. It really doesn't say what's going on. We're doing it to align with the audit profession. I get that and certainly want to be cooperative, but at the same time, we have a lot of preparers out there, and I don't think it's right for them to take on something just to align with the audit profession if we're going to require something additional over and above what we're already doing, which is a lot with severe financial stress and probable dissolution. I think there are components of severe financial stress that might get to their definition. I agree with Jeff that what we've got is more informative for most users. The credit market and certainly legislators and others are going to get more information out of what we're doing. So I agree with the staff recommendation. I'm open to looking at something else, but I really don't want another definition of going concern. So now we got 3 definitions out there floating around that the preparers are going to have to make a decision on. I'm not happy with that.
Yeah, just to be clear, Jackie, my world, there's not an additional evaluation. The additional evaluation is defined as the evaluations they are already doing. Right? It's just you're putting it under this umbrella term.
So Deborah has her hand up and wants to comment.
Yeah, just to respond to the umbrella term idea. So the way that we're envisioning things going forward, if we decide to pursue going concern further, is we would be looking at it as a third aspect of this project, where we would deliberate what going concern needs to mean separately from how we're going to redeliberate severe financial stress and probable dissolution, because we don't want those to affect each other. So as an example, in the preliminary views, the probable dissolution included if they're going to cease to exist due to a merger or acquisition. And we've heard a lot of feedback that auditors say mergers and acquisitions are not part of the going concern concept. Those should not be part of it. At the other end, though, we've also heard users saying they want those disclosures if there's a merger or acquisition. And so we don't want to be kind of swayed one way or the other if we're saying that going concern and probable dissolution are going to be the same thing. At this point, we want to be able to make those decisions independently. And then at the end, we can come back and say, okay, well, maybe going concern is probable dissolution, except for the mergers and acquisitions. So it may not be an exact umbrella term, but it may be more, there may be more of a third evaluation that has to be done. It may not be completely independent, but it might be additional. Now, a lot of that's depending on what happens in other decisions in this project, but it's from our view, it's a little premature to say, oh yeah, we can just define this as exactly that and be done.
Thanks, Deborah. Chris.
I agreed with the staff recommendation. I guess the key drivers for me were one, I did not want another term, another definition, and a definition that I thought wouldn't really add value. I think the team has done a really good job over the, year and a half or however long we've been working on this project, in identifying those key issues. And we started off in going concern, but then moving to probable dissolution and severe financial stress and really creating those two buckets. And one thing that we talked about was this umbrella term, which an umbrella term really essentially requires you to change the underlying definition and make it different than what those other standard setters have, because that umbrella has to work for the things that are under it. And then I think what we're describing now, what Deborah's describing now for a third option, I just really don't see the value in, to Jackie's point, having preparers have to come up with this term just for the sake of, nostalgia, just to have going concern, because we've always had going concern. But the fact that governments, and we always say how different governments are, and it's reflected in these terms that we haven't now adopted from some other standard setter, but we've implemented on our own through our research, et cetera. I think that that's the way that we should go about it. And I think there's been nothing so far in the project over however long it's been going on to make me think that we need to bring that going concern idea back to government.
Thanks, Chris. Robert.
So going in, I've been inclined to support the staff recommendation. I think that's still where I'm at. Jackie could have just written my comments because that's basically what I was saying, and Chris had a couple other little points, but I'm struggling with I'm struggling with reconciling this from the auditor side. I am, and I get it that it shifts that balance, but even if even under the existing, if management didn't make the assertion, and so we don't require them to in effect make that assertion as part of GASB guidance, they still have to make that determination. I just coming into this, with the work that's been done in getting up to speed, I think SFS and probable dissolution are just vastly improved concepts that provide better information for users of financial statements. And I'm concerned that we be muddying the waters if we go to a third aspect, regardless whether it's an umbrella or on top of, as Jeff maybe described, or others have talked about. I'm not that concerned that preparers would have to do that, but I think it muddies the waters, and it makes the work that's been done and the concepts that have been advanced less useful.
Thanks, Robert. Carolyn.
I initially was one of those who was not supportive of probable dissolution, primarily because of the familiarity, history, and what I thought was a common understanding of the term going concern. I initially thought that introducing a new term such as PD, possible dissolution, would lead to confusion for the few times that a government would need to disclose. As the feedback has been received from stakeholders and the reasons some had an issue with the PD, it became apparent, at least to me, that it was more of a historical usage of the term and not the perceived conflict with, and I know there could be debate here, and not the perceived conflict with the auditing standards regarding going concern. For the longest, I was always, would go to a conference and would hear how going concern was not really, as currently constructed, was not relevant to governments. So we heard that and we did this project that looked into, okay, what is relevant to governments? And after all the feedback that we got and the analysis and the recommendations from the staff, I agree with the staff recommendation. While I support that there are sometimes times when we should try to converge or be similar to other standard setters, I do not believe that this is one of those times. I believe that there is a very strong reason and to come up with our own terminology that reflects governments. And I also believe that if we continue to use going concern, I just see with all the different definitions that other standard setters have, I just see it adding to the confusion versus doing what we want for our standards to do. So I had a lot more written, which I'm not going to go into. But with all that said, I do agree with the staff recommendation.
Thanks, Carolyn. All right, so Jackie said she was open, and then Chris and Robert and Carolyn were varying degrees of how comfortable, almost certain they were in their opinion. We're all kind of near the fence, but we ended up on one side or the other. I'd like to maybe pitch one more, I don't want to say time, but the ability to maybe not totally shut the door. This sounds, this is probably doesn't sound great. Because what Jeff described is really what I think. I heard a lot of concern for developing a third definition, a third term, didn't want to do that. I agree. I agree totally that umbrella term is a term I kind of like to use, but it's an umbrella that maybe only covers part of each of them. It's not umbrella covering all of them. And I too don't want to lose the work we've done on probable dissolution and severe financial stress. I will tell you though, as we get to severe financial stress, and I kind of sort of said this earlier, if we don't somehow something like make as management is evaluating whether or not they are in the condition of severe financial stress at year end or at whatever point in time we want to make them assess it, that they don't have to assess whether they're probable of being insolvent, not near insolvency, but probable of being insolvent within 12 months as part of their assessment of whether they're near insolvency. The auditors are just going to have a problem. We're going to get a lot of pushback if that's not somehow encompassed into that. Does that mean it has to have the term going concern? Maybe it doesn't. But I think when we get to SFS, we're going to have to at least consider something like that, and we'll see where we go from there. But my idea, my kind of path forward was you add that as a super indicator the management has to do. And if they make the determination that they're probable of being insolvent and not being able to pay their obligations as they come due, as the PV defined insolvency, then they're near insolvency, period. They're in SFS. If they're not probable of being insolvent within 12 months, they have other things they need to think about, like the things we included in the PV, to determine that they still might be near insolvency enough that they're in severe financial stress, and they're in the severe financial stress disclosures. And then maybe over on PD, it's probable dissolution caused by mergers and acquisitions, or in this section of probable dissolution caused by severe financial stress is this other section. So we kind of got two versions in a way, or a cordoned off separation of SFS that's probable of insolvency and other SFS. We've got probable dissolution of caused by SFS and probable dissolution for mergers and acquisitions, and going concern would just be the two things that are probable dissolution caused by SFS and SFS caused by being probable of 12 months of near insolvency. And that's it. Like that's the umbrella is over part of each of them. We don't have to define going concern. We could just say something like that. And that's probably further than Deborah wanted me to go with looking at potential paths forward and things like that. But I think there's a path forward that isn't as hard. I don't want to say hard, but is as bad as as some of you seem to be worried we might do if we kept going concern. So I'll stop just a second and let Alan and Jackie talk. I guess I'm just asking for, can we keep this a little bit in the back of our minds as we go forward with probable dissolution and SFS, and maybe once we get done with them, circle back and say, hey, is there a workable thing using these that isn't too complicated but would help the auditors, or are we just good where we are? But all right, said my piece. Alan, then Jackie. You're on mute, Alan.
In an effort to not try to start debating what SFS and PD should be, because I know Deborah wants to do that at a later meeting, which I really appreciate, I would say that there's three takeaways I've had from all the conversations we've had with various stakeholders. And you can include very much so the auditors in this thought process. Number one, some of them have point blank said they're okay if the term doesn't exist. What they want to be able to do is reconcile their auditing framework to whatever we do in this project. If they can reconcile their auditing framework to what we do in this project and the term doesn't exist, some folks have suggested that they'd be okay with that. With that said, for them, going concern is so much more about 12 months from insolvency than anything else. And so it's possible that we go on about this process, get to determine what we think SFS is, Deborah, I think this is somewhat you were saying a minute ago, get to determine what SFS is, get to determine what PD is, and then ask ourselves, can you reconcile what that is? Or could they, maybe we don't necessarily have to do it, but could they reconcile what that is to 570? And if they can, then from what I've heard, we should be okay. If they can't, or we don't think they can, then we have a different conversation. But I've actually heard folks say that it's more about that. It's more about the ability to see within whatever we come up with, the ability to see going concern within it. The word term reconcile has been thrown around, but I don't mean an actual reconciliation, but to see it within it. And if they can, good. But we're not going to know that until we get further along in these deliberations and we redeliberate what SFS is and or what PD is. And so not having it now would be somewhat consistent with some of them saying they don't necessarily have to have that. That's not their primary driver. Because if we're assessing SFS and we're assessing PD and they can reconcile those two things to going concern, then in their world, the preparer would have assessed going concern, even though they didn't do it directly, they did it indirectly. And they understand that.
Alan, maybe that's a better way to describe what I was hoping we could circle back and do. Maybe that's a
Well,
good way instead of revisiting going concern, at least making sure we can reconcile it to the auditor's going concern once we get through it. Maybe that's.
I put my hand down earlier I wasn't sure I was going to say it, but then when you said what you said, it felt like the nice segue to go ahead and just say what I was thinking earlier.
Jackie.
In my comments back to the staff, I did indicate that to me, it seemed from all the conversations we've been having and what I've been reading, it was the time period that was the biggest problem with them rather than the terms or anything else. So I had said, when we're looking at severe financial stress, I would be willing to look at that and consider that. That would not be an issue for me. So from that perspective, I'm open to looking at that. I agree with what Alan said. It might be premature for us to try and come to an answer on this until we've nailed down where we are with the other two. But for the governments to be doing another assessment, and even if we pick pieces of PD and SFS, that's a new definition. So that is asking for a new definition from them. But from that perspective, I'm willing to look at timing. I'm willing to say, sure, if we want to talk about it again after we get done with those two, with severe financial stress and PD, I'm willing to do that. But doesn't necessarily mean my mind will change, but I'm willing to look at it.
Thanks, Jackie. Chris.
Also where Jackie is, and I know some of us are probably thinking it too, but if we get to the point, right, and we're okay with where we landed with our two definitions, with our two anchor principles, then maybe it's on the audit standard setters to change how they're doing things on their sides, right? Instead of us trying to reconcile over to them. So if we work and get to a point where that's as far as we can go as a board, then there's another side that can move as well. You know, it's not a one-way street.
Thanks, Chris. Well, I hope that we can at least do that, what Alan described. I think that was probably a good description of once we get these two things, what they think they can be. And I appreciate the openness to look at the time frame, because Jackie, that's kind of sort of what I was saying, that's that assessment that looks 12 months out for our insolvency is, I think, the deal breaker for the auditors. And that's the time period kind of sort of you're talking about. At least time period's a part of it, big part of it. And so, you know, hopefully we can get to something that will work for the auditors within the construct of our two terms that we're moving forward with. And I would appreciate that consideration as we move forward into those terms. And then circling back, talking to the auditors, which we will continue to communicate with them about this decision and what the next steps are and what they can look forward to, and continue to engage with them and get their feedback. And we'll be able to hopefully bring that to you as well, you know, throughout as we move forward. So, Deborah, that means we don't need question two?
I'm not sure what the actual decision is, or is there a decision?
It's 4-3 in agreement with staff.
Yep, that's what I heard. Not using the term going concern.
Jackie, Chris, Carol, and Robert are in agreement with staff.
Right, but then I heard several board members talking about coming back and trying to come up with our third thing anyway, even if we don't call it going concern.
What I heard is board members maybe wanting to do what Alan described and seeing if what we come up with is reconcilable to the audit profession in some way, shape, or form by them or by us or whatever, and just seeing where we are, not necessarily revisiting use of the term.
Yeah, I took it, Deborah, to be this way. We've kind of sided with a majority that don't want to bring the term back. But we have to realize we do have the auditors out there with a very strong opinion. And so what I was saying is, but we don't really know where we land in relation to their opinion until we get through all the rest of these deliberations, which we haven't done yet, which we're not trying to do today. Until we get through all those conversations, then we really would know whether or not we've landed in a place that might cause them angst or not. This decision alone doesn't answer that, because that's why I was making the point of, we've heard them say, if the term went away, that's not a showstopper for them. But what they care about more is some of the discussions we're going to have later on, right? Which you know that we haven't had those today. We're not trying to have those today. So, but I heard a majority vote for not keeping the term.
Chris.
Yeah, I would agree with Alan. And in my mind, the way I saw it as once we have further discussions around what disclosures might look like and other things, maybe there's a way in a SFS disclosure to be able to capture the things that are important from a going concern standpoint, if certain fact patterns are reached or something like that, versus in other ones where it's not, you don't require certain other disclosures. So, I just open to the idea that you might be able to scratch that itch by other means.
So I do think, Deborah, the way you set the paper up, though, is if you did get majority agreement on question 1, we didn't need to do question 2. So I think that means we don't have to do question 2 today, which would theoretically mean that you would be done for the day.
We would not do question 2 ever.
Right.
Yeah.
We wouldn't postpone it. We wouldn't do it unless, God forbid, something happened, we had to bring it back. But as it sits right now, we wouldn't do question 2. I agree with you. So that would probably mean we're good for the day.
Yeah, that was all we had for this meeting. Coming up next, we plan to start into the severe financial stress redeliberations.
Right into the fun stuff.
All that's left now, right? So I don't say all that's left. We got probable dissolution too, but I mean, that's next steps. I appreciate the work. I appreciate the discussion. And we look forward to getting into SFS, I guess, next. That'd be great. Thanks, Deborah and team. Again, appreciate all the work, the survey, the interaction with the stakeholders. Is very helpful. And I know it takes a lot of time, but we appreciate all the efforts you guys are putting in. So thank you. All right. With that, I think we're going to stop the board meeting for today. We'll pick back up with cyber security risk research presentation tomorrow morning at 10 a.m. Eastern. And then we'll go into revenue and expense recognition, and that'll be it for the board meeting. But the board itself, we do have an admin meeting after this. So let's take 10 or 15 minutes and at like 4:20 maybe go back in the other link for our admin meeting and see everybody then. Otherwise, see everybody else tomorrow. Thanks, everybody.